Good morning, everybody, and welcome to today's Investors Expo's free training presentation. We got four great speakers today. I always love catching the other speakers because, I also like to pick up, new things that I can incorporate into my trading. And, today what I'm talking about is trade setups based on the order flow that you can use and add to your trading. And, what you're going to learn today is the important parts of order flow. Order flow is really a lot of information for a trader to digest. And I think that's one of the reasons why a lot of traders shy away from order flows because, they see a lot of numbers and markets moving pretty fast sometimes, and, they just feel overwhelmed. But I'm going to show you how to concentrate on the pieces of order flow that really matter and how you can incorporate it into your trading. Then I'm going to talk about how to put those different pieces together, right? Because, it's one thing to have a puzzle piece, but you need to know where it fits in the whole puzzle. Okay, so that's not just having the piece of information, but how to apply it to the market. And lastly, I want to talk about a couple of order flow trade setups that you can use right away. And whether doesn't matter which order flow software you use, you should be able to use the information that I'm giving you today and apply it to the markets as long as you have a way to, most software now, I think Tradeovate just released a footprint chart just this past week, but most major trading platforms now offer an order flow footprint chart so you can read the order flow as it's coming in. So just really quick, those that are new to one of my presentations, just, quick, briefly who I am. My name is Michael Valtos, and, I've been running this company, Orderflows.com, for the last 5 or 6 years. I started in 2015, I think, so, we're coming up on the 6-year anniversary later this year. And before that, I spent 8 years at JP Morgan as Vice President of Futures Trading. I ran a trading desk at Cargill for 4 years. I was at Commerzbank. I was the licensed Eurex trader there for 3 years. For 2 years, I worked at EDF Man on their global macro trading desk. And I started on the CME floor with Dean Witter back in the early 90s. And eventually I left the trading floor to work on their upstairs trading desk when electronic trading was starting to basically take hold in the industry. So I've literally been there from, not the very beginning, but, from its infancy when the exchanges started moving electronic, and I've been trading electronic ever since. Now, like I said, in 2015, I started my company Orderflows.com, and we have a software, right? It's called the Orderflows Trader, and it runs on NinjaTrader 8. And what it is, it's a volume footprint chart that allows you to read the order flow, and it's got 17 pre-programmed order flow indicators. The reason why this is called Orderflows Trader 3.0 is because this is the third version since the original version in 2015. We upgrade it about every 2 years. So the last one was in 2018, and we just did a big upgrade back in last year, back in August of 2020. And it's just fascinating how you can use software nowadays to help you as a trader understand what's happening in the order flow. And, the reason I just bring this up is because, I want you to understand the charts that I'm using in this presentation are generated from my Order Flows Trader software, in case you were wondering. Now, before starting this orderflows.com, I started writing a book on trading order flow because up until that time, back in the mid 20 in the teens, 2013, 2014, there was very little information for traders on how to read the order flow. And, I had been trading with order flow for, a long time. I don't want to say decades, but, a long time. And there's a lot of things that traders just don't know about order flow. And that's why I started writing this book. And as I was writing the book, I realized, why is the software available so basic, right? Why can't it do some of this analysis that I'm writing about in my book, the things that I'm looking for in the order flow? And that's how the Order Flows Trader came about. Now, if you stick around to the end, I'm going to show you how to get a copy of my book for free. It's the PDF version. It's not the hard copy version, hardcover copy version. It's 150 pages. It's a good reading. I even people hit me up on LinkedIn and stuff like that and say, hey, you know what? I've read your book. It's really helped my trading. So, it's a very useful tool for a lot of traders. Now, before I dive in, just a brief disclaimer, do understand trading involves risk and you should only trade with money that you can afford to lose, right? I don't want you thinking that it's all, sunflowers and roses. Trading is work. It's not something that is meant for everybody, but you know what? If you become good at trading, you could have a fantastic lifestyle. So the first part I'll talk about is the important parts of order flow. Now, most traders, right, we look at a normal bar chart, okay? But the order flow footprint chart takes that information that you see on your bar chart, but adds in more information, okay? So remember, everything that you see on a chart, whether it's a bar chart or a footprint chart, comes from the same source. It comes from what's traded in the market. And the basic way to look at what's traded in the market is by looking at the time and sales. Okay, but the problem is with looking at time and sales, it's moving so fast that you can't see what's trading. Some people now like to trade on the DOM, the price ladder. But again, the problem with that is you're just seeing what the bids and offers are in the market. You're not necessarily seeing and keeping track of what's being traded. And what's being traded is very important information. Now, the footprint chart takes all that information and puts it into an easy to read format, okay? And out of all that data, right, you see on the screen a lot of information, but there's three main points that order flow traders focus on, and that is the delta, that's the point of control, and that's the imbalances in a bar, right? Every bar is going to have a delta. Every bar is going to have a point of control. Point of control is, the place with the most volume, and imbalances. Not every bar has them, but bars that have them can be very revealing as a trader. So just really quick, what is delta? It's the difference between aggressive buyers and aggressive sellers in a bar. Now, delta is important so you know who's dominating the current market as shown in the bar, right? Think of it this way, right? Anytime someone buys at the market, right, that's delta means +1. If someone sells at the market, that's delta -1, right? Negative delta. So when you take the difference between the volume traded on the offer versus the volume traded on the bid, you have the delta. And delta, on most software is at the bottom of the chart. Some people like to have it printed, above the bar or below the bar. I just find it easier for me to have it along the bottom. Right? Again, some people have it printed above or below the bars, but I like to keep it in the same spot rather than having to, so I know where it is basically. But generally, as you see, as the market is selling off, as it's going down, you have negative delta, right? Generally, as the market is rising, you're going to have positive delta, right? You can see the positive, the green boxes down here on the bottom is the positive delta. Now there's other pieces of delta. There's max delta, min delta, and cumulative delta. Unfortunately, I don't have time to get into all that right now, but if you go to my YouTube channel, I've got a lot of information on that, how to use that. So the next important piece of market data that's generated from the time and sales and put on the order flow chart is the point of control, right? And the point of control in a bar is the price level with the most volume. Now, there's no fancy mathematical formula to determine it other than simple arithmetic, right? You're looking at the volume that was traded on the bid at a price, the volume traded on the offer at that same price. And if that price level has the most volume in your bar, whether you're using a minute-based bar or volume-based or tick-based or whatever you're forming, whatever way you're forming your bar, there's always going to be one price level with the most volume, and that is your point of control, right? And on a footprint chart, you're going to see there's a box, like not a box, a rectangle put around those price levels. Every bar has one. I've highlighted a few in here. Whether it's an up bar or down bar, it's going to have one. Now, I have this one highlighted in yellow as opposed to blue because, this is a special one. Okay, this is a special point of control. So every bar has a point of control, but not every point of control is going to matter, right? There's going to be certain points of control that are bullish, indicating support, or bearish, indicating resistance. This is a bullish one. That's why it's colored light blue in the box as opposed to gray. Now, the next important piece of information on trading order flow is imbalances. Understanding when there's a market imbalance occurring. And basically what it is when there are more aggressive buyers than sellers, or vice versa, more aggressive sellers than buyers, but this time in the two-way auction, right? The point of control measures volume at a price. The imbalances measure the volume, but in the two-way auction, right? Two-way auction is the market is bid at one price, offered at another. So it's like 5 bid at 6. Okay, so say there's 5 bid for 10 contracts, there's 20 offered at 6, one contract trades at 5, but 8 trade at 6. You have a buying imbalance because you have more buyers than sellers. So how do you define an imbalance? Well, a buying imbalance occurs when there's at least 4 times as many traders buying the offer than traders selling the bid, right? And a selling imbalance is the opposite. It occurs when there is at least 4 times as many traders selling the bid than traders buying the offer. Now, again, the 4 times as many, you can adjust that. I know some traders that use 3 times as many, 300%. I know some traders that use 5 times, 500%. I even know some traders that use 10 times, 1,000%. But 400%, 4 to 1 is about, sort of the industry standard. And again, in the footprint chart, not every bar is going to have imbalances, right? And the ones that do, it's going to be highlighted, right? Buying imbalances are blue color, right? You can see the blue ones in these bars. Selling imbalances are red color in the bar, right? If it's just normal order flow, it's just a black number inside the bar, okay? Because remember, right, markets exist to facilitate trade, right? For people to transfer risk from themselves to somebody else, or people to take on a risk. But when you have an imbalance of buyers versus sellers, that's important information. It's telling you, people are happy to either take on the risk, or people want to transfer the risk. Think of it this way. If people think that they are buying something at a very low price, they're going to be aggressive, right? And you often see buying imbalances, right? Because everyone's thinking, oh my gosh, this is such a good price, I got to buy more, right? So you're going to have an imbalance until the market starts moving up, and then it finds balance again, right? The markets move from balance into a different phase called imbalance and back to balance, right? That's why markets go up and down, is trying to find balance. Now, generally speaking, as markets rise, you see buying imbalances, right? Why? It's because aggressive buyers are lifting the best offer and looking for the next best offer. Demand is present. Generally, again, I say generally because this is not always the case. I mean, markets do go up on negative, on selling imbalances, but that means something else, okay? But generally, as a market falls, you see selling imbalances. Aggressive sellers rather, are selling into the best bid and looking for the next best bid to sell into. Supply is present. Now, like I just said, just a quick caveat. I say generally because, as the market's going up, right, there's a lot of demand. So people are lifting the offer, they're buying it, because they think prices are going higher. But sometimes you do see selling imbalances in a market that's moving up. Why? Is because somebody is there absorbing the selling that's going on. Might be a lot of selling, but there's a big buyer, a big passive buyer who wants to buy a lot but doesn't want to move the market higher. So he's there happy to absorb that as the market is going up. He just keeps raising his bid. Sellers come in, hit those bids, thinking that, oh, price is too high, but that buyer is very important, right? And that's, some of the nuances that I get into in some of my advanced trainings and things like that, as a trader, you can understand, you really get a good grasp of what's happening in the market. Okay, so now that you know what point of control, delta imbalances are, let's start to put those pieces together, right? Because, it's one thing to have that bit of information, but again, you got to know how to use it, right? And when you look at a normal bar chart, this is a candlestick chart, what do you see? You just see you see where it opens, what the high, the low, the closes. Candlesticks are, very visual, right? People like to look for patterns in candlesticks. And, I gravitated to candlesticks when I first started trading back in the late 80s, early 90s. That's sort of when candlesticks started becoming popular. Prior to then, people would just use a normal open, high, low, close bar. And I was always fascinated on why some bars look the way they do, or why a market would pull back right to a particular level or rally up to a level. And it wasn't until I started reading the order flow that I understood why this market would rally back right up to this level, stop, and then sell off, right? Then the market would put in the swing low, rally up, come right back down towards that swing low and bounce off of it, right? Because by understanding what's happening in the order flow, I could see if there's market generated resistance or market generated support, or if we're breaking through support, why, what's the aggressive selling look like? Why do some candles have these big wicks, right? And because a lot of traders, they like to look for these candles with the big wicks, but understanding what happens in those wicks is also going to give you very, very tradable information. Now, this is what an order flow trader sees, right? Someone that's reading the order flow is going to understand why this market started selling off from here, right, at 41.05, right? Well, this is the area right over here. We hit this low, we rallied back up. Why is it stopping here and then selling off? Okay, but if you're reading the order flow, and you understand things like points of control, you would understand that this is a very bearish point of control. And I'm going to explain a little bit later what else is going on in this bar and this bar as well that is keying off a potential bearish signal, right? But if you're just looking at reading, the normal candlestick chart, you don't know yet, because you're just going sideways, right? You're just hanging around sideways in this little area in here between 4100, 4105. It looks like it's just going sideways. And as a trader, you want to know, are we going to go back up, test 15, or go back down and test 95? But again, if you understand how to read the order flow in here, it gives you very revealing clues, and I'm going to explain those in a minute. Now, what's the difference between a normal bar chart, candlestick chart, and an order flow footprint chart? Is, well, the normal bar chart, the information you get is the open, high, low, close, and if you want, the volume for the bar. Okay, that's okay. That's a starting point, but why limit yourself to that? And a footprint chart is going to also give you the open, high, low, close, and the volume for the bar, but it's also going to tell you the volume that traded on the bid, the volume traded on the offer, what the delta was, the difference between aggressive buying and aggressive selling in the bar, who was in control. It's also going to give you max delta and min delta, right? Max delta is how strong the buying was in a bar. Min delta is how strong the selling was in a bar. And there's trade setups you can take based on what you're seeing develop in the max and min delta. Now you also have cumulative delta. Okay, cumulative delta is the running delta total for the whole day starting from the beginning of the session. Okay, and obviously, when delta is cumulative delta, you're coming into, a certain time of the day, 10 o'clock, and you have a big, strong positive delta, it gives you an idea, the market is pretty strong, right? If, it's 10 o'clock in the day and delta is kind of mixed, hovering around zero, then, the market has got very little direction, right? Or if it's a big negative cumulative delta, the market is weak. Now you also have imbalances in the bars, okay? And again, I've explained, what that is you have more aggressive buyers than sellers, or more aggressive sellers than buyers. Now you also have the point of control, okay, which is, again, the place with the price with the most volume in the bar. And more importantly, now in the latest version of Orderflows Trader, you have the value area. So the value area high, the value area low, okay? And that's also a very important piece of information. If you've ever studied market profile, it's based on understanding where value is. And you could even take it down now to a smaller level and understand where value is in a bar. Okay, so it's going to give you an even clearer picture of the direction of the market, right? Because when you look at market profile, you just look at the value area for the day and maybe the value area for the previous day and where we are in relationship to it. But you know what, if you're trading intraday and you can see how price is reacting around current value, either the current bar that you're in or the last couple of bars, you know, it's going to help you with understand the direction of the market right now. So having more information is one thing, right? You have to know how to use it and apply it, right? You don't want to be drinking out of the fire hose because you're just going to be flooded, right? But you know, when I was growing up, right, the show MacGyver, right? We all remember MacGyver, right? The guy would take a paper clip and save the world, right? You know, he would defuse a bomb with a paper clip, or he would start a car with a paper clip. You do all these things with a paper clip, and you know, order flow is that paper clip. It gives you a tool that if you know how to use it, you can interpret what is happening in the market, right? Sometimes, you know, yeah, the quote, I love this quote, right? A paperclip can be a wondrous thing. More times than I can remember, one of these has gotten me out of a tight spot. And order flow is the same way. By understanding what's happening in the market, right? It's not, you know, people think that, oh, you know, I have to have some fancy algo to understand what's happening in the market. You don't, right? You just need to read what's happening in the market the same way you would read what's, you know, a story in a book, right? Again, your normal candlestick chart, if you're looking at it, it's difficult for, you know, a lot of people that they'll just look at it and say, oh, you know, this was a great sell-off, right? You can see all these red candles. Well, as a trader, right, when it's trading up in here, right, up here, you don't know it's going to put in all these red candles. You don't know if it's going to put in all green candles, right? It's nice to look after the fact and say, oh, that was so obvious. You know, you got this inside bar, then you got this and this happening, you know, that it's trading is easy. Well, it's not, right? Because as much as we'd like to look at it after the fact and, you know, armchair quarterback it, when you're a trader and you have to make this decision, you want to be able to make the decision with current information as what's trading right now. Okay, just as this big sell-off here, right? You want to be able to get short as quickly as possible. You don't want to wait till the market, you know, people say, well, yeah, it was a great short. You can see it broke the swing low. Well, where would you rather be getting short at? 90 down here when it breaks the swing low, or up here at 98, you know, as it starts moving away from this swing high, right? This is your profit potential. Even though this is a nice profit here, where would you rather be getting in? Down here or up here, right? If you understand what's happening in the order flow, you can understand that this market is turning, right? And get in earlier, right? If you're getting short down here, where's your stop? You know, heaven forbid it's up here at the swing high 10 points away. You know, if it's at the swing high, you're better off getting short up here at 98, just risking, you know, 2 or 3 points rather than risking three or, you know, 3 times as much, 10 points. So again, you know, this was your normal order flow chart, right? And I was talking about some of this information earlier, right? Points of control, right? Imbalances, right? What's happening in the delta, okay? So as a trader, you want to identify key areas, right? And this is where having good software is going to come in, right? Your software should help you identify those areas so it leaves some of the decision making of just should I take this trade or not take this trade rather than trying to determine, oh, is this point of control important, right? And this point of control here is important. That is right here. That's happening right here. You got a very bearish point of control happening in this bar, okay? But again, you're not going to know if you're looking at a candlestick chart that that's important because you don't know where the point of control is on the bar. Let software identify it for you. Now, the other thing you can start looking at is the delta. What's happening in the delta? Okay, well, you see delta in this bar is 2. That's nothing. You know, most of us trade 2, 3, 4, 5 contracts at a time. We could, you know, this delta could easily be negative. Okay, but it's 2, so it's positive 2. Now with delta, you know, I use a certain buffer. You know, I use in the E-minis 50 delta. If it's within 50, then it's basically neutral. Okay, but 2 is basically neutral. Then over here you got a 0, a 7. Yeah, here you got a strong delta of 321. So delta is mostly neutral here. Okay, you got 3 of these 4 bars with basically very, very small delta, 0, 7, and 2. But then we got a bar with a bearish signal in the point of control, indicating market resistance up here. Then the next bar, a big negative delta, 476, okay, followed by another bar with big negative delta, minus 467. Now, what else do we see? Well, we're seeing one selling imbalance here, two in this bar, two in this bar. Okay, so you're starting to put the pieces together, right? You've got selling imbalances, you got resistance based on the order flow, right? In the bearish point of control, that's why it's colored magenta, right? You got small deltas, then the deltas turn negative, right? A strong negative. So yeah, you're starting to put those pieces together and understanding what's happening in the market. Now, the next thing I'll talk about is the value areas of the bar, right? And you can see these bigger boxes around a bar, right? That's the value area. So I know that's the value area high. This is the value area low, just as this is the value area high. This is the value area low. This is the value area low. This is the value area high. Okay, but what else do we got? Well, we've got a gap, right? We got a gap in the value area from the value area low here to the value area high here. Okay, then the market tried to come back up. You know, it rallied 2 ticks from where it opened, couldn't even close that gap, right? And then the market started trading down, then down, down, down. So you got a gap in the value area, right? You know, most of us are familiar with gap theory and how to trade it, especially when it comes to value areas on the market profile. And you're just taking sort of the same concepts that you're seeing in market profile, but you're able to apply them on a smaller time frame, right? But you're also adding in what's happening in the delta, what's happening with imbalances, and with points of control. Okay, now this is one of the tools that we have added in the new version of Orderflows Trader is what we call slingshot POC, which is bearish or bullish POCs, extremely bullish, extremely bearish, right? This is a resistance POC, but what we have is we will draw in on the POCs that are bullish or bearish, right? Here you had a bullish one. Yeah, market sort of went up, but then it ran into resistance, right? It ran into this bearish POC. Then as we gap down in the value area, another gap down in the value area. Now we're starting to see some extremely bearish POCs. That's why they're colored red. If they were bullish, they would be colored green. And you could catch this move down. So remember, right, for a market to move in the direction you expect it to, there needs to be follow through order flow in the direction you expect the market to move, right? And we often talk about taking trades in context. You hear that a lot. You get trade in context of the market. Well, what is context of the market is understanding the market structure. Would you be looking to buy after the market just rallied 10 points, or would you be looking to sell when you have bearish information coming in after a market rally 10 points? I find the better trades are the ones that happen around turns, because it's going to give you bigger profit potential in the sense that bearish information is coming into the market. So, without the follow through order flow, right? Again, it's not just about having, I've got a bearish signal here. You need to see the next bar follow through, right? You need to see the next bar follow through. Just like here, right? You've got a bullish signal, then you got some buying imbalances, but you got no follow through here, okay? Instead, you're seeing the negative order flow come in. So even if you're getting long in here, the fact that you're seeing negative POC, negative value area moves, you're seeing negative delta, you know to get out of this trade. You don't need to let it go stop you out. Even if you got long, at 04 and you have a stop, at 4,100, you don't need it to come all the way down in here. As soon as you see this negative information, you could manage your trade, right? You could get out at a smaller loss. And that's the beauty of order flow, is when you start noticing the opposite flow coming into your current position, you can get out, right? Because what causes the market to move is the buying and selling. It's not your indicator, right? It says, well, my indicator flashed, so everyone should be buying. No, it's just whoever's using that indicator sees that. Order flow is made up of all the traders that are trading in the market right now. That's why the markets move, is because the actual buying and selling that's taking place in the market right now. Again, this is yesterday, right? Market sold off. It got down to 70 and a quarter. Then we started to rally. Okay. Well, what do you see, right? If you're an order flow trader, right, you can start seeing this information, right? You can start seeing the selling imbalances, the strong negative delta as you're going down, right? Then you hit the low, then you got positive delta, right? You got a divergence. Price made a new low, but you got buying coming in, right? Positive delta, that's a divergence. Next bar, you're seeing buying imbalances coming in, right? You don't see any buying imbalances really on the way down. You see one, but that's it. But now all of a sudden you hit this new low and you're starting to see aggressive buying coming in. What are you starting to think? Well, maybe buyers are coming in at these low prices, right? Price, there's a saying, price is an advertising mechanism. Well, if it gets low enough, you're going to attract people to the market to buy at these levels, right? Just like, Bitcoin, right? When it gets down to a certain level, people love to buy it, right? Whether it's Bitcoin or a stock or whether it's, groceries, things that you would normally buy. If it's on sale, you might not need it right now, but it's such a good price, you're going to buy it, right? You're going to be aggressive. And then you start seeing the deltas go from negative to positive, right? Now you're starting to see points of controls move higher, right? Which is also bullish. And I'll be honest, one of the toughest trades to take is buying off the low of the day or selling off the high of the day. But when you're using order flow, when you start to add value areas into it, right, you get a big better picture, right? As the market's moving down, you're seeing value move down. Now the market's starting to move up, right? Value gap, right? Market's moving up. Value higher. Value area high is higher. Value area low is higher, right? We're starting to make that move back up. A nice quick move for, 10, 15 points. So let's get into the good stuff, right? The order flow trade setups. I'm going to discuss two of them today. And the first one is multiple buying imbalances off a low, swing low. It doesn't have to be the low of the day, or selling imbalances off a swing high or a high of the day. So, again, I just pulled up these charts from yesterday, just to keep it current. And here we are. This red line is the low of the day. And you're seeing, a couple green bars. Well, here's a green bar. This one's a red bar followed by a green bar. Now, again, if you're looking at the order flow, again, it doesn't matter if you're using other software out there. Like I said, a lot of software now has this type of chart for you. Okay, so might as well start getting used to it, right? Don't not use this information. I mean, if someone says, hey, you know what? I could tell you, when aggressive buyers are coming into the market. Would you be interested? Yeah, right. And it's all it is just putting this chart on your screen. You can still have your candlesticks. You can still run your normal indicators on top of it, but it's always nice to see where the aggressive trading is coming in. So if you're looking at this, I like looking at lows for buying opportunities if they're there. I'm not trying to pick a low. I'm just watching the market make the low and saying, hey, you know what? Is there a chance to buy here? And I see here, 1, 2, 3, 4 buying imbalances. Okay, the market go up. Yeah, the next bar went up a little bit, but then just went sideways. Okay, that happens. We've all gotten into trades and the market goes sideways. Then we came down here, poked down, made a new low by a point, then boom, snap right back up. You got another bar with 1, 2, 3 buying imbalances. Now over here, you have two bars that have stacked buying imbalances, 1 and 2, right here. Okay, and this is how most order flow traders look for imbalances. They look for stacked imbalances. But what I'm trying to impress upon you today is they don't need to be stacked on top of each other. They just need to be in the bar, right? Now this bar here has got 3 selling imbalances. But again, do you really want to be getting short? I mean, can the market go lower? Yeah, it can, right? This market went lower here by a point, then it went lower again by a point. You could say, well, yeah, the market went lower but did it? It only went a point lower, whereas this rally, was 7 points, right? Would you rather try and short for an extra point or buy a rally of 7 points? Think about it, do the math. 7 is better than 1. Okay. Now, if you're using normal software, you can just see that visually, right? You can see those imbalances. But one of the things that we have in the Orderflows Trader software is the ability to highlight to you where these bars with the multiple imbalances are. Here. Now it's also showing you the bar with the selling imbalances, right? This one here got 1, 2, 3 selling imbalances. But again, do you really want to be getting short at the low of the day, or would you rather have us for the same reason, just in the opposite direction, to get long off the low of the day, right? Me personally, I'd rather get long off the low of the day than go short into the low of the day. Of course, the market can go lower, but I just find, you know, better trades at the lows of the day if it's given me a reason, right? I'm not trying to pick the low. I'm just saying, oh, there's aggressive buying coming in. It's not till you get to these bars that it really starts to show up. But where would you rather be getting long, off this bar or off these bars up here, right? It gives you a better entry a little bit earlier. Okay. Now this is the one I was showing you earlier, right? We came down here quite, market's coming down hot, right? And then just boom, snaps back up, right? And what do you see, right? You see one buying imbalance, then this next bar with 3 buying imbalances. They're not stacked neatly on top of each other. You got one down here, then 2 here, right? And then the market rallies from, whatever this is, 75 all the way up to almost 85, quick 10-point rally, right? Then people will say, well, there's a stacked selling imbalance in here. Isn't that bearish? Well, if it holds, yeah, if I was long off this bar with multiple buying imbalances and I got a stacked selling imbalance coming in, I want to monitor it, right? I want to see if this is going to hold or not. Well, it didn't hold. It immediately failed. Okay, so that's good. And the market continued in that direction. But again, you want to be able to be highlighted when these bars with multiple imbalances are appearing right here, right? If you're just looking at this, you might miss it, right? Use software that's going to highlight that to you so you don't miss those. Now, the next one is the value area gap, right? And this is sort of, a carryover from market profile, right? And it occurs when a bar opens outside the previous bar's value area and does not trade back into it, instead trades away from it and forms a gap from one value area to the current value area. You go in that direction. So basically, this is that chart I was showing you earlier. Would you short here, right? Some people would, some people wouldn't. But when you start looking at the value areas, right here, you got that big gap in the value area, right? Would you get short here, right? Market's starting to rally, right? You're seeing stacked buying imbalances. You're seeing multiple buying imbalances here. You're seeing positive delta. Then it just sort of stops here. So if you're long, right? If you're long from down here, right? You're thinking, oh, happy days, we're starting to rally, right? Then what happens? The market falls over. Okay, this is where having a tool, looking at the value area is going to help you. You got this big gap here, right? Some people say, oh, it's just getting this little pullback and it's going to start rallying up again. But it can't even cover this gap, right? It's just, you see this over and over, right? When you start looking at value areas in the bars, you see these gaps over and over, and I don't want to say it's an automatic trade, but you just really know. And then you see in here the stacks, the multiple selling imbalances. Obviously, we got the negative deltas. The max deltas are 0. So this market's about to fall over again. Whatever buying that you had earlier is probably going to get overrun and the market's going to make those new lows. So order flow analysis, in my opinion, provides the trader advanced information that they need to get an edge over other traders. Remember who you're competing against, all right? It's not always yourself. Yeah, you have to have the mental aspect down, but you're also competing against other traders, because when I don't really like to use that term, competing against, basically you're trying to take their money and put it in your pocket. Okay, so what you want to do is you want to have an edge over them, and you're going to get an edge over them by looking at things and understanding what's happening in the market that they're not even considering, right? They're not considering where value areas are right now in a bar, they're not considering where points of control is, what delta is doing, what imbalances are doing. Most traders are looking at normal bar charts, right? So you want to see what other traders don't see. Now, again, this was that low down here at 70 and a quarter, right? I've showed you this one a few times today, right? You got multiple imbalances, you're selling off, just, as you would expect. Selling imbalances, negative delta, starts to rally up, right? But then when you add in the value areas, right? When you start adding in the imbalances, right? You can see it in here. Now this one, it opened right on the value area high, traded 5 contracts into the value area, and then closed up. But you got that big gap there, right? So hopefully by now you can see how powerful order flow analysis is, right? don't overcomplicate trading. Right? Again, everyone, I want to take this indicator. People have this thing called what I call indicator stacking. I'm going to put 10 different indicators. So that's going to give me 10 times a better chance of being right. Well, actually, no, it's going to give you probably a 90% chance of being wrong, because there's going to be one that's right, everything else is wrong, and you're spending a lot of time looking at everything that's wrong. Just trade what's happening right in front of you. Is buying coming in? Is selling coming in? Right? And that's where having good software is going to help you, right? So if you found this helpful, you're going to really like my Orderflows Trader 3.0 software package, which makes order flow analysis super easy, right? And again, it's the Orderflows Trader 3.0 for NinjaTrader 8. It's the volume footprint chart with 17 pre-programmed order flow tools. I've talked about just today, I've just talked about the multiple imbalances, the value areas, and there's, imagine you got another 15 other tools that you can use, right? There's POC tools, there's market weakness, there's market sweep detection. There's a lot of tools that you can use. And again, I said get my chart template, but actually the way the software is set up, it's set up for E-mini 1-minute chart, so you could go and modify it from there. If you use a different type of chart, just let me know and I could guide you. And normally I sell it for $8.99 on my website. But again, having order flow software is one thing. You have to know how to use it. So I don't just give you the software and say, here, go figure it out on your own. I provide a lot of education and a lot of training on how to use the software and how to read the order flow using the software, right? Now, each week I do a private live group training session, Tuesday nights at 7 p.m., just for users. Now, if you can't attend, you can watch the recording. And, this is your chance to have me, look over your trades, ask me questions about the software, or, hear me talk about interesting things I saw in the order flow recently, or talk about, some of the tools available in the software. And I've been doing this for over 2 years. There's over 100 and I think now 120 sessions. Some people are going to charge you extra for this. I mean, I don't understand that. Right? They charge you thousands of dollars for their software, then they charge you on how to use it, right? And I think that's really what separates what I do from other people, is because I want you to succeed. I just want to sell you software. I want you to understand how to use it and become successful at trading. So I also offer you for free my order flows trading course. And I normally sell this for $297. You're going to get access to it for free, as well as this video series that I did of 56 videos a few years ago of my inner circle series. And this was a special thing for users of my software. There's 56 videos on advanced order flows, tricks, tips, analysis, how to use, so what to look for in the order flow and things like that. And if you start adding it together, it comes out to over $1,600, almost $1,700, $899 for the software, $297 for the training, $497 for the inner circle. Add in the weekly group training, which is probably worth more than $200 a month. Its price starts going up there, but again, you're not going to pay that, right? And I even got a special bonus because of Investors Expos keeps having me back. My order flow playbook, right, with 10 trade setups in there that you can use to start applying to your trading. And we give you that for free as well. Normally it's $297. So you add all that up, it comes out to almost $2,000, right? But you're not going to pay that, right? Success comes from learning, training, instruction, and practice, right? So if you're interested in the software and all the training, it's just a one-time payment of $749. Go to orderflows.com/oft3.html, right? It's going to take you to the page. There's no more payments in the future, right? I'm not going to charge your credit card and keep charging you every month like some people do that you can never cancel. Just a one-time payment, $749. Go to this page, orderflows.com/off3.html. Looks like this. Download, scroll down, takes you to this button. Click here to buy now. Takes you to PayPal. PayPal processes it. I don't get your credit card information. I don't want it. PayPal handles all that. So if you stuck around, you want my book, go to orderflows.com/book.html, enter your name and email address, click submit, and it'll take you to the download page. So most important piece of information I give you is get started, right? You got to get started if you want to be successful, right? If you just sit on your butt for a year, you're never going to reach any sort of measure of success in anything, whether it's trading or professional career. So get started. Go to orderflows.com/oft3.html, and I'll see you guys on the inside.
Well, good morning, everybody. Great to have you with us. Saw Michael kick this off. It looked very interesting, and I'm going to seek to continue quality training here for you, focusing on a more aggressive option strategy. Let me ask you first, I'm kind of curious, get your feedback. How many of you are trading options? Give me a Y or an N for if you're trading options. I've been trading for 30 years. Always interested to know what people are into and trading. And the big thing that I want to focus you on, we're talking about a more aggressive approach. I see a lot of you are trading options, is you've got to get speed of movement. So in order to find these kind of home run opportunities, you really have to find things that are moving fast, because as we know, when we buy options, it's a time decaying assets. It's only got so much time before its expiration. So the faster you can get on the speed train, the better. A couple that, if you didn't, I saw one that didn't actually, and most everybody said they did. But if you don't trade options, you can still use what I'm going to teach you for even stock and other vehicles, because you want that speed of movement whenever you trade. It's always good to get your profits faster rather than slower. Just a reminder that everything I share with you today is for your information and education only. Nothing we're talking about here should be considered a specific recommendation to buy or sell any particular investment. As you know, you are 100% responsible for your own investment decisions. Big Trends and staff are not responsible for trades you choose to make. Not all products are appropriate for all types of traders and investors, so keep your risk level in mind. We don't provide any personalized financial, tax, or legal advice to any individual. We call out real-time email and text alerts to our Grand Slam option subscribers. So we're going to walk you through that today. If you don't know me, I've been trading for over 30 years. Been blessed to be in this game for a long time, and I attribute a lot of that to intelligent risk management, not just good chart reading, but you got to be a smart trader in terms of how you manage your risk. And we'll talk about that today. It's inducted into the Traders Hall of Fame in 2007. And, with a lot of giants in the trading industry, there's so many smart folks out there. And the big thing you should be doing is standing on the shoulders of giants, learning from others who have been through this for decades, so that you can take advantage of this in your own account and really build your knowledge while you build your portfolio. So we're using a baseball analogy here because a lot of people these days seem to want to be content with going for singles. And there's money to be had taking small profits, but what I find that messes a lot of people up is that they take small profits, but then they end up taking big losses. That is not what you want to do. That's not the secret to success. So we're talking about buying options for $1 or less, because these are really leveraged contracts where you can control oftentimes a stock that 100 shares might cost you over 100 grand. You can control that stock for a lot less, potentially as little as $100 per contract. And so what we're looking for here is at least a double in baseball terms. That's second base. So we get to plus 100% over here. That's a double on your money. At second base in baseball analogy is a double. That would be our first target. And if we can get a double, we're going to take half of our position off the table at a double. What does that do? It allows you to take your risk capital and put it back in your pocket. Now you have the proverbial free trade, but we're not going to stop at a double. We're going to shoot for a triple. If we can get there on a triple, we'll take half of our remaining position off the table at the triple. That's third base in baseball terms. And if we can hit the four bagger, get to the 4 times our money, 300% gain, that's the true home run grand slam, is where you clear the bases and get 4 quick runs at once. The idea there is that that's where we'll take our final target. So we're going to kind of gradually take our profits, but at bigger levels. You say, how is that possible to get those kind of gains? It's because you're buying a very leveraged contract. Now, for that, you also have risks that you could lose what you put in the investment. And sometimes that happens. We obviously seek to minimize that. We're going to walk you through our Grand Slam options approach here and get it moving here, because I got to pack in decades worth of knowledge here into this short block here. So what we're looking at on this chart here, we've got several indicators. We're going to go through all these indicators together when they all line up together. The first one here in blue is a CCI. It's a Commodity Channel Index. Both of these on AMD tried to get going, both the CCI and the percent R. It's a Williams percent range indicator in that red overbought period there. The green line is the ADX. These are the three pieces that I'm going to help you put together here, and you can use all these on any time frame. I'm keying on the daily charts for these moves, but you can use them intraday as well. I do myself. But the first time we were trying to get through that breakout on AMD, that's Advanced Micro Devices, one of the big semiconductor success stories here in recent years. But you can see that first one did not follow through. So the lack of follow through, I call it confirmation or lack thereof. If it doesn't confirm that initial setup point, then I don't take the trade. This next one that's happening here on CCI and percent R was kicking in. You can see right off of this high. And at first it didn't confirm. That next red candle is like, oh, it's not confirming. But look, that second day after it did confirm, check mark, we're good to go. And we bought there right off of that next morning's open at about 62 bucks on AMD. Notice that first day we're actually down. I think we're down about 20%, maybe 25% that first day in that trade. If you put too tight of a stop on a trade, you're going to flush yourself out of a lot of great opportunities. What do we buy? We bought a 75 strike call, usually out about a month. This is about 6 weeks ago, um, maybe 5 weeks ago before the expiration. And the thought being that we're not going to be in this trade very long. It turned out we were only in it for 2 trading days, um, about 48 hours, and we got our 300% profit. Why? Because the stock went from 62. First day it dropped to 58, and then the next day it goes up to about 68, up about 10 bucks. Second day it's up to about 72 at the peak, and we're cashing out. So you can see that it doesn't have to get to the 75 level for you to book those profits. But these are called out of the money options because they're cheap for a reason, because if they finish, they're out of the money, you lose what you put into the trade. So how does this work? It gets more valuable as it goes from out of the money to the strike price and then going to in the money past the strike price. But even up to the strike price, a lot of times we can get our targets and book it and move on. If you say, why should I care? If you look at our Grand Slam options performance, you had a $5,000 model portfolio, you can typically put in on a buck or less. We say you can get in for as few as 4 contracts. Will cost you as little as $400 per trade to get started. But we tend to recommend that people could go up to even $1,000 a trade, because we're not going to hold more than a few positions open at once. But you can see on this example, with $1,000 a trade, we would be up 16,000 plus. Before commissions, knowing that commissions are minimal these days, that's been one of the best things that's happened in my 30 years of trading. So while past performance doesn't guarantee future results, we have a lot of confidence in this system because we've been able to do this. Here's an example just in the past month here with Moderna, late April. We were getting one of these breakout signals. Moderna is one of the big vaccine names. It's been one of the great new sectors because of COVID that has really moved a lot. Now you can see here on this chart that we already have percent R kind of breaking out. This red line here on the upper panel is my big trends band. We'll get into that too. That one was confirmed way back here. But you can see the CCI, the blue line was a little slow to get going on the bottom panel here. The ADX was already going. So the ADX, you can see if I put an A by it here, it was also going about this period. But the CCI didn't really start to kick in, especially on my shorter term CCI readings, until this point here where we bought that morning. Stock was about 168, and that day it went up about 10 points to about 178. Notice what we bought. We bought a May 230 call. You're going, hold on, it's 50, 60 or 60 points out of the money, and you're going, what are you guys doing going way out of the money like that? And then notice, because it went up that quick 10 points intraday, we got our double on the first day. So the beauty of this is that was the first half of our trade. We took the risk off the table. Whatever happened after that, we say we don't worry about it. So the beauty of that is that you can focus yourself on speed of movement, get your risk capital back, and then give it a chance to go for those bigger triples and quadruples. When I think of home run leaders, I think of Babe Ruth. I've been watching the Ken Burns baseball series on PBS again. It's just phenomenal. It's a must watch if you're at all interested in baseball, and frankly, just the history of the era. The Babe, of course, lived big in the 20s and 30s. The market ran up huge in the 20s, crashed in the 30s, and he kind of was a personification of that. But 714 home runs in his career, but he had almost twice as many strikeouts. Now, we try not to strike out. We try to take a loss where we need to, but I'm going to talk about a different way to take losses, not a price stop, but what I call a time stop with this approach. So pay attention here today, because you're going to learn something new with time stops, as well as how to find these situations. The Babe said, I hit big or I miss big. We want to try to hit big, but we try to limit the missing big, but know that you can lose what you put into a trade from time to time, where it just doesn't move, or it might move quickly against us once in a while. We might strike out once in a while. We don't want to strike out twice as often as we hit home runs, that's for sure. But he's truly an example of a 6-time champion on top of all that kind of volatility. But the key here is that indicators like CCI, this was developed by Donald Lambert at the start of the 80s for the futures market. And we've shown it to work with a lot of big name growth stocks. So it works on a lot of big movers and a lot of different sectors and investment vehicles. But CCI is different from the traditional moving averages and other things, because it doesn't just look at closes. The calculation of CCI factors the high plus the low plus the close of that bar, that candle, and then says divided by 3 to get what Lambert called a typical price. If there's one big lesson I want you to take out of today's training with me, it's that overbought as a quote unquote word is often overused and misused. Overbought, in the way that I look at things, is actually not bad. It actually can be powerfully good. That's such a what hit the brakes? What are you talking about? Overbought could be good. It actually shows where if you see institutions that want to buy and they want to keep buying, that's telling you that they're going to keep accumulating that stock. When it goes overbought and the institutions don't care, or they just keep buying, you look back at all these charts and say, wow, that thing stayed way overbought way longer than I thought it would, right? And so from this perspective, it's about focusing on these unusual overbought situations that keep going up. Same way, if oversold stays oversold, watch out below, they're dumping that stock. Okay, so you've got to kind of change your perspective on some of these situations and say, look at something going overbought. You can see it with CCI, ADX, and percent R happening in here, and then confirming on that very next day. So it confirmed back here. This was Facebook back in March. And then we said, look, we want to buy right off of that little pullback open right there. Thank you very much. Facebook trading in the neighborhood of about 280. Again, we're buying out here a little over a month away from expiration and buying 40 points out of the money. The 320 calls, we entered them at 99 cents. That means you paid 99 bucks to control 100 shares of Facebook stock that's worth 28 grand right there. Okay. And you say, okay, so you can control a $28,000 stock for under $100. So the leverage potential on this is obviously huge. When Facebook has that quick rally from 280 up to about 300 in the next couple of days, you can see we got 102% on that first target the very next day. And then as it started to go up a little more and then reverse on us intraday, we took 85% on our trailing stop. After we get a healthy profit of a double plus, we start to trail our stops up. We said, okay, now we just want to hop out here because we don't like that it's not continuing intraday, and that short-term momentum is so important. So speed of movement. Speed is what it's all about. Quick 20 points, and we said, thank you very much. We'll take the double or so in a couple days and move on. Then it pulled back to 280, and then it broke out later again. So the point being that, look at Microsoft. These are big names, right? You don't have to trade some kind of small cap, never heard of it, or just starting to hear about its stock. You can do this on the big FANG stocks and the big names out there in the marketplace, as long as you catch them in their right speed of movement phase. Mr. Softy, as we call it, broke out here. You can see broke out right in about the middle of January here. And as it broke out, that was right when we picked it up. It's like everything was signaling for us on right off of that little break above this big trends band. You can see in just a couple days, we managed to pick up 104%, and then we got our 206% target there on the fourth day. So, and look at what Microsoft did. We were buying, again, the stock's at 225 here. We're buying a 250 strike call, about 10% overhead, and we paid 88 bucks a contract, again, to control about $22,000 worth of stock on 100 shares for 88 bucks. And you say, okay, look, it didn't take a huge move. Look where the stock went. It went to the mid 230s, and we're getting a triple in 4 days. On the fifth day, as it started to roll over, didn't get our last target starts to roll over, we take 122% on that final piece. All this happening within 5 days. That's a week's worth of trading. So we have an option that has about a month's worth of life. We hold it for about a week, and we should know in 5 days if that thing's moving or not. So these quick overviews here on these pieces of the puzzle, it's hard to say, okay, that's an eye opener for a lot of people that say, oh, I would never trade that. That's too risky. Well, the beauty is, you know what? You can control your risk with both our time stops and with the fact that you don't have to allocate more than 4 contracts. If you were going to try that trade, for starters, you can see you get in for about just over $350, less than $360 on 4 contracts. So you can really dramatically keep your risk down and say, of course, if we can make a double, triple, quadruple, that few $100s can turn into 1,000 plus in very short order. So now ADX, the average directional movement, this was developed by Wells Wilder. It was the same guy who developed the relative strength index, or RSI, that a lot of people like as an overbought, oversold oscillator. What Wilder was looking at there is that the DMI plus and minus lines basically show you if we're getting DMI plus going up, that's a set of new highs, DMI minus going down. If DMI plus is going up and DMI minus is going down, you know what that's going to mean? That the gap between those is widening. That's going to mean ADX is going up. That's, of course, the definition of an uptrend, higher highs and higher lows. So the key here is that you want to focus on, okay, where we're getting this trending effect kicking in. And that's what makes it such a powerful momentum and trend indicator to say ADX must be rising. We prefer to be rising from a low level and starting to cross. So here's the green ADX line, the bottom panel here. On AstraZeneca, back the middle of last year, when the COVID pandemic was in full force, AZN came out and said, we're going to be announcing some study results on how our COVID trial is going with Oxford University and AstraZeneca. And we said that study's coming out the next Monday in a few more days. We said this is an interesting breakout right in the midst of this pandemic, where we said, look, the stock's trading in here in the 57, 58 area, and we're out there buying about 20% overhead, 65 straight calls that will expire in that third Friday in August, about a month later. So this is not something where we're using weekly options. This is something where we have more time to let these play out, but we don't expect to need that much time. We paid 83 cents or 83 bucks to control 100 shares. You see the stock's trading about 58 bucks. That's about $5,800. So you would say, well, not as huge a leverage potential. And yet look what we did, 100, 201%, and 357% in 3 trading days. I remember it well, where that was a Wednesday where we got in, and then by Friday we'd already gotten to our second target of 201%. And people said, shouldn't we sell it out before the weekend with all this news coming out? And said, no, you want to give it a chance with that news coming out to hit your final profit. A lot of times I see a lot of traders these days who have developed so much what I call scar tissue, where you say, okay, if you've had winning trades that have turned into losing trades and you get antsy and you start taking your profits too quickly, you're out at 100%, or a lot of people are taking them at 20 and 30% gains. We're going, that's not the right way to trade this more growth-oriented approach. You want to give yourself a chance for the bigger score, because you don't want to have small profits and then end up taking bigger losses. So for us, we cashed out that last piece right after that open when it rallied up to 64. Look what the stock did. It rallied about 10% in 3 days, and we got to 357%. That's 35 times leverage on a 10% move in the stock, right? That's tremendous for a very short holding period of a few days. So that's speed of movement phase. You don't want to trade this little range here for the weeks leading up to that. You want to trade the move outside of the range. The trend is what we're focused on, not the range. Now, the third piece of the puzzle is I call it big trends bands. It's another way to visualize the percent R, percent range indicator developed by my friend Larry Williams. Larry is definitely another great trading innovator, a true giant in the trading and education industry for traders. And he developed this percent range indicator to show kind of what the range has been over any given look back period. And of course, when percent R goes overbought, that's when I've left the color in red here, because most people would say, well, red's bad, right? Well, actually, red here is powerfully good. You can see what Baidu, uh, often called the Chinese Google, was getting ready to do. As it broke, and what I've done is I've codified it to show this light blue band shows you where we're at the top of that range based on percent R. And you can see, do I want to trade that range? No, I want to trade the move outside of those big trends bands. Look at the acceleration happening here. And you could say, gee, Price, you made good money in 4 days. We're up 300%. Take our final target, and then it goes even higher. And sometimes that happens. But my experience is once you get that 300% final target, a lot can happen. It could go more, or it could actually start to reverse in my trading experience over doing this for many years. So I'm like, why not just go ahead and book that bird in the hand, take the 100, 200, 300% gains, and be very happy with the result. Whatever happens after that is up to the markets. This one kept going. Notice that we lay all the indicators on here. We want to see that first setup broken out. For percent R, it happened right there. For CCI, it was setting up the next day and breaking out, and ADX had already confirmed for us way back here. So all three legs of the stool were bullish, so we bought that next morning here. And you can see day after that, we're taking a double. 2 days later, the triple, the third day, or 4 days total after that entry that we got to 300%. You can see that it's just a powerful sign when you check all the boxes. Percent R is good, CCI is good, ADX still good, and trending very powerfully. So the beauty of this is that that's going to be a situation where we take our sweet spot out of the middle of this move. I don't try to call lows. I don't try to call highs. I prefer the middle of the trend. It's the more consistent piece. I mentioned about the Greeks and options, and this will probably sound Greek to you if you're new to options. When I launched Big Trends in 1999, I was mainly focused on high delta options. That's saying that if you're looking at something where the stock's going to move a buck in your favor, a high delta option would mean that you should get a lot of bang for your buck on that. Typically, it's an in the money option. If it's higher delta, like an 80% delta would be a deeper in the money situation, almost what I call a stock substitute, because you're trying to manage that theta loss. That's the T for theta, T for time. Time decay being your biggest enemy when you're buying options. A lot of people buy options incorrectly. They don't get the speed of movement, and then they say, oh, it must be a seller's game, it must not be a buyer's game. The reality of options is it's both. You can make money buying, you can make money selling. You just have to know what you're doing. You've got to have a plan. What's happened with me? I don't mess with Vega, because Vega is for more of an earnings trade. Implied volatility jumps and drops, especially big around earnings time. In this approach, I don't mess with that. But here, what we're talking about is the biggest effect that's really shifted my options buying is saying high gamma options. So it tells you where you're going to pick up a lot of deltas on a 1 or a 2 point move, or 3 or 4 or 5 point move. You can pick up a lot of delta really fast on high gamma options. What are the likely high gamma options? They're a little bit out of the money, is usually where the peak gamma is. Not too far out of the money, but as it goes from somewhat out of the money to at the money to in the money, that's where you're going to get your big delta kicker, where it might start off at a 30 or 35 or 40 delta, and then quickly goes at the money to 50 delta, and then it goes a bit in the money, it goes 60 and 70 delta. Whereas if you're already in the money with an 80 delta, the next point move might take you to an 82 delta. You just don't pick up a lot of deltas on a 1 point move. That would be a low gamma situation. We want that high gamma to work for us. So that speed of movement going from out of the money to at the money, and sometimes to in the money, is so powerful. This might be one of my favorite charts of all, because it's an example where we were wrong initially. And if you used even a 50% price stop, you would have flushed yourself out of a great trade by thinking you're just being sensible and using a 50% stop on an aggressive approach. Because look at what happens. This just shows CCI and percent R here, setting up. Next day, gap up, and it closes up, well up. And we've got a buy signal now on Morgan Stanley to get into the calls. So right here, right off of this next morning's short-term peak, the stock's trading here around 47. We're buying a June 49 call. We paid 95 cents, 95 bucks a contract to control 100 shares. It cost you just under $5,000, 4,700 bucks. So notice that we're wrong, right? The next couple of days, yuck, right? So if you start counting out the days, 1, 2, 3, 4. By the 5th day, we're right back to where we got in. If we're negative after 5 days, we say get out. So it was really crunch time. But on the 5th day, we're flat. So it's like, give us one more day. 6th day, we're going nicely positive. The next morning, it gaps up here. That red candle shows you it gapped up there. That's 7. right off of that open. Stock's about 51 bucks. So instead of taking a 50% loss on a 2-day quick pullback, we end up taking out 247%, 224, and then 146% because of the gap. The gap up, we're like, look, we're already at our 200% plus total target. We averaged a total of 220% on this trade to hold it for 7 trading days. So take the quick stop. No, thank you. We're going to give it 5 trading days. That's called a time stop. So on a daily chart, 5 trading days is a pretty good rule of thumb for me to say, okay, we know that about those next 5 candles, we should know if we're right or wrong and not get flushed, because with the out of the money options, they can move a lot. You don't want to get flushed out. If you're down 50% and then you finish up 220, that'd be a 270 percentage point swing. Same thing here with Zoom video. This was a little different pattern. It's what I call a retest pattern. It came in, got whacked on some bad news after the pandemic's first run to the upside for the stock. This was last April, where you can see it came back down. People were worried about a security flaw in the video conferencing software leader. Said, look, it's right into this retest zone here about 115. We're going to buy it in here at 115 and bet that it can snap up real quick. Notice at 115, what strike price did we buy? A 200 strike call. Some people thought I was nuts, saying, can you believe that if you buy it? This was had about 6 weeks to go before the expiration. We're like, hey, give it 5 days and let's see what happens. You start counting out 1, 2, not much happening, and then 3 starting to move, 4 really moving, 5. We're nicely profitable. On the 6th day, we're cashing in for 101 and 200% gains. 7th day, it stalls. I thought it can keep rolling. 7th day, it stalls, starts to flatten out. We take 117% on that piece. You can see it dips, then comes back up, and goes flat again. So the point being, the speed of movement phase was in this window right here, right? So that's where we really got that kind of bang for our buck, and then we cashed it in and said, okay, we're done, move on. The point of all of this is that a lot of people would say, okay, where do you buy these options? How far till expiration? How far out should you buy your expiration day? Most people would say if you go out, say, 120 days before the expiration, that's 4 months. 0 is the expiration day. And they'd say, well, look, you don't lose much time premium in that first 30 days. Wouldn't you want to buy that because you don't lose much? The problem with that is that guarantees you're going to have an earnings report in there. You've got a lot of time premium you're paying for plus volatility of the earnings. And so you actually end up crushing your leverage. Our experience is that somewhere in this 30 to 40 day window here, about 4 to 6 weeks out before expiration, if you only hold it for 5 days to the 35th day, that's a very manageable little decay rate right there, okay? Or the 35th to 30 day. These are manageable decay rates. They're a little faster than obviously further out, but they're still manageable so they're not falling off too dramatically. One thing we do say is once you get down here to about 14 days before expiration, 2 weeks before, don't mess with it. It's not worth that fast decay risk. So we always close all of our trades, win, lose, or draw, 2 weeks before expiration, and we won't put anything on that's got that kind of short-term expiration decay rate. So the 30 to 40 day window for entry is really good. So right now, here we are a week to go before the May expiration. I'm looking at the June 18th expiration, about 5 weeks out for a brand new trade that I'm eyeing right now. Now, bottom line is that we trade a lot of the big name movers, the Babas, the Baidus, Microsofts, a lot of tech, NVIDIA, and you can see some other fintech like PayPal and Square are now on our list to go with Visa and MasterCard. In the credit card space, we trade some big oil like Schlumberger, or some gold like Rand Gold, now bought out by Barrick Gold, but still some with GOLD. And even casino stocks now are now reopening trades with Vegas Sands and Wynn Resorts. So a load of financials, Goldman Sachs, Morgan Stanley I just showed you, and a lot more. Here's another Baidu example which shows you why we take profits early. Or early being at 300%. That's good enough for me. This one had an earnings report, put an e-bite on this earnings gap right here, okay? And then we waited on it. It was like just starting to give me that ADX signal. Percent R was just starting to break out up here, and then CCI is just starting to come on board. Everything came on board right here about a little over a week after the earnings. And the stock's about 250. We bought the June 290 calls about 5 or 6 weeks to go before expiration, paid $1 for them. And then we got 100, 200, 300% on the 6th trading day. So actually both our 200, 300% targets here happen on the 6th day. Now you say, gee, shouldn't you have held on because it went a little higher by it'll put an 8 by it. Would have been the eighth day in the trade, right? Eighth day in the trade, you would have been more profitable. But the ninth day in the trade started to flatten out. Look what happens by the 10th, what would have been the 10th day in the trade. Big gap down, 11th day in the trade. Of course, you're way below where you got in. You'd be taking a big loss. So this is why you don't hold and hope for more, because sometimes those big gaps happen and don't give you that ability. Big gap here, put a G by it. Gaps are probably your biggest enemy in trading. It can be good for you, but they can also be bad for you because you don't give you a chance to risk manage the trade. So for us, taking those gradual target profits, really wise. I love getting emails like Srikant said, great start, great to start the service with a winner, first time over the last year trying many different services. We can't guarantee that, but obviously we're motivated to want to give you a great experience. Robert Romine wrote in and said he was struggling with his trades and began using percent R, something that I taught as part of this portfolio, and you can see percent R allowed him to have a big turnaround. His total portfolio almost tripled. My highlighting here, more 100 and 200% winners than he ever had in the past. I love seeing stuff like that. And smaller losers, bigger winners. That's the secret to success, right? Trend trading says let your winners run, cut your losers quickly. That's what we seek to do at Big Trends. So what's great about like a name even like Apple, so we get into Apple and you think Apple's too slow. It's like got so much cash. What are they up to? Over $200 billion they're sitting on in cash. So it's almost like a cash substitute, very, very conservative equity position, right? But yet institutions love it because they can pile into it very easily and get exposure when they want to get exposure. So the beauty of this is you see that Apple's giving us our signal, all systems are go as of the beginning of this bar. Notice for the first few days we're in this trade, nothing's happening. In fact, it's even going a little bit against us, right? So you're going, okay, well, use the 5-day rule. And then they announced this iCar thing, and the stock pops at the prior day it had been down below 125. Then it pops up to about 134. Quick little snap up pop, and we're doubling our money, 104% gain 4 days later. you know, Makes us move up. We get a little bit more gain, but not to our next target, and end up stopping the rest out for a little bit under 100%, somewhere back in here. So the point is that what, when we see this happen, we got to be patient. Got to give it a chance to move. And if you're not patient with your trades and can't handle the 5-day rule, you probably need to look at something else that fits your temperament. For us, this is really ideal. What I love about it is that we're not committing a lot of capital. To control Apple stock worth more than 12 and a half grand, we're paying 88 bucks per contract per 100 shares. So, you buy 4 of those, you're controlling 50,000 bucks of stock for, again, less than 360 bucks. So it's really tremendous how you can get this kind of leverage. So, what we're showing you here is that some of the big keys for being a successful Grand Slam options trader. This is something where you got to have that catalyst. You got to have that driving factor. For us, it's the system. When you're looking at a systematic approach here and you're saying, okay, I know I need to uh, follow a system because I can't be emotional about what I'm doing here. If I get emotional about trading, I am done. I am in trouble. So I've got to use the system to drive the effect. By buying these out of the money options at a buck or less, that higher gamma is where you're going to get that really great bang for your buck as you give that thing a chance to not make a 1-point move, but to make a many point move, a multiple point move in your favor, letting that trend run, giving yourself a chance to just keep on having it pile on top of each other with more and more delta gained as that multi-point move is happening in your favor. So one trader asked, are you selling a third of the position each time? So yeah, we sell half of our position at a double, and we sell another piece at a triple, and then the final piece at the quadruple. So those are the keys. The time stop is an eye opener for a lot of people. Price stops will get you whipsawed a lot of the time. The time stop gives me enough of a chance to say, uncle, if it's not working after the 5 days or more. If it's unprofitable on the stock after 5 or more days, get out. We're done, moving on. But if it's still working, we give it a chance to keep working. So booking that windfall, the doubles where you get that risk capital back in your pocket. Sometimes it gaps even past that. So you say, thank you very much, take half off the table, then go for the 200% and the final 300%. on those gaps. Capital allocation is really key too. You don't want to be overcommitting your capital allocated that you use to trade the Grand Slam option service. We recommend 5 to no more than 10% of the capital you'd be trading going into a new trade. So if you're only trading with, say, even $4,000, you can basically say, okay, I'll put $400 into a trade. I'll get you at least 4 contracts. You can follow the rules and then build your portfolio up as you go. So, and we give you weekly video training as well. Quick little overview of kind of the frequently asked questions, if you will, on the service. So is it an options recommendation service? Yes. And what type of strategy? We're buying out of the money calls or puts. We're not doing spreads, no spreads. We're keeping it incredibly simple. You can start with as little as $4,000. Recommended option price, it will have to be at $1 or less. We will never pay more than $1 or $100 to control 100 shares per contract. So that way, whenever I'm looking at things, if I'm like, okay, like Tesla's hard to trade now because the market makers aren't even putting that cheap of an option out there on a few of these really high dollar stocks. So you'll see that, if it's not out there, I'm not going to be trading that one. Okay. I haven't traded that one in a while. But that's okay. There's loads of other opportunities. How much money to allocate per trade? $400 or more. Like we said, looking at obviously one contract for $100 or less, but we like to see you get at least 4 contracts. So typically thinking about getting as much as $400 in a trade as a starting point for even smaller traders. But of course, if you're trading with the bigger amount, we just say start small and build your confidence. That's a big part of it. How many new trades am I making per month? We say typically in the 6 to 8 trades a month range is what we're targeting. So a trade or 2 a week on average. How long we've been in this trade? Like we said, we like to give it up to a week. Although if we get our targets quickly, like I showed you in Moderna, we got that double the same day. It's not a day trading service, but if I get a double the same day, well, of course, I'm going to sell half my position up 100%. So you've got to be sensible about realizing that we're going to take that money as the market makes it available to us, but we're not going to stop trades in the service until we've gone at least 5 trading days. And we do have all kinds of data. If you want to study the data, you can call our 800 Big Trends toll-free line. We'll show you that in a minute just to remind you on that number so you can get more information as you need it. We do send the trade alerts both via email and also text alerts. So we encourage you when you get signed up, take advantage of the email sign up, and then you can get the follow up with us about how to set up text alerts as well. We give you the profit target levels, we give you specific instructions, and I like to give you some extra bonus materials today as part of this. So, because I know I'm having to go fast. So what I'm going to do is I'm going to give you, the first bonus is going to be my option settings and rules sheet. Gives you all the settings, what you need to plug in when you get signed up. Then you're going to also get my weekly video training, and you get all access to this and past video training as well in the member site once you get signed up. And then there's an extra special bonus. I'm going to give you my Gamma Options Boot Camp. This is a digital on-demand, multiple hour, about 3 hours plus course that I walk through for my subscribers to help you to understand all the elements that go into options analysis and finding these high gamma options on a regular, repeatable basis. So what I want to do is I want to show you just a reminder, first of all, that if you look at how fast you can pay back an investment in this, this is if you break it down, making thousands per year on average. But the point being that we want to kind of keep that growth and that compounding going. We want to keep you green and growing, as I like to call it, never getting complacent, always being very focused. We're acting as like extra eyes for you on the market to find you these opportunities and call them out for you in real time whenever we see them. So when you add up all the different things I was walking through, what I've done actually is I've actually given you an extra special bonus too. I didn't mention it, but usually for a year on my site would cost about $4,000, $39.97 for a year's access to Grand Slam. So 2 years would be $8,000. I'm giving you the equivalent of all of that, plus all the other bonuses with the video updates weekly. So that's 52 weekly video updates. The Gamma Options multi-hour bootcamp training, 297 value, and the settings and rule sheet, 197 value. All that adds up to $8,900, almost $9,000 of value. I'm giving you, you can see like 90% off here for $997. One-time investment. and it's just a really great way to get started. So it's at this link here we've set up for you. It's members. It's not a www link. www link. It's a members.bigtrends.com/GSO24. So when you go to members.bigtrends.com/GSO, that's the letter O 24 for 24 months instead of 12, this page pops up. And so with this page, what you're going to see is it's really simple. It's $9.97 with all the bonuses I'm throwing in for you as well. So you get all access to that. And all you have to do is we encourage you to review. We've already taken the promo code down 90%. So you're saving, like I said, about $8,000 total on this, from $9,000 down to just $997. So check out this terms and conditions link. It's clickable. It reviews all the terms. Like I said, I've been here, launched Big Trends in '99, so we're on our 22nd year. We've served tens of thousands of traders with great content and great, more importantly, quality real-time education on how you can take advantage of various opportunities in real time. Review that terms and conditions, and we give you several different ways that you can, once you review the terms and conditions, you review that, pay with a credit card, or if you've got PayPal, that's the quickest way. That'll just reroute you to get your PayPal info in, and then boom, click it, and you're in. One-time investment. There's no future charges here. You've locked in 2 years of access, all for 90% off of the usual price. So think about that. 2 years of access, $997. That's effectively $500 a year. We're not offering that here, but basically you're locking in 2 years access for the equivalent of $500 a year, $997 for 2 years, plus the recurring ongoing access you'll have to the Gamma Options Bootcamp and all the other pieces that we show you here. So the beauty of it is, let me see if I've had a couple of questions. Also, so success rate comes up. So you can email us. Like I said, there's on that page, by the way, there's a toll-free number, our 800 Big Trends number, which you can see it's spelled out there, 800-244-8736, or just remember 1-800 Big Trends. Get to us toll-free, or you can click that link for emailing us at clientcare@bigtrends.com if you have questions. I've got real humans standing by that can help you. It doesn't put you through a bunch of voice prompts. You can talk to one of our people on the 800 line, or you can email us and we'll get one of our client care team to get right back with you to get you any information. If you want to study performance history, feel free, email in. We'll be happy to send you the full multi-year history, or anything else that's on your mind about studying the rate of success. The reality is, when you're buying aggressive options, you don't need to have a high win rate to win big with this approach. What you need is to have some winners that are going to basically carry you when you're making 200% and 300% target profits on the second portions of your position. The beauty is that, hey, we get a double, we've already got a risk-free trade. But when you get the 200 and 300% targets, that carries you. So it doesn't take a lot of those to score really big gains on a portfolio basis with this approach. So let me see if I missed any other questions. Want to learn everything about options, going to enroll in your classes. Thank you very much. I think you'll enjoy the continuing education that you get with the weekly video training in this package, plus the bootcamp education. And that's the videos and the bootcamp are just so powerful, so you can truly learn while you earn. It looks like that's answered the question. So go to that members.bigtrends.com/GSO24.
Hey, everybody, I'm so excited to be here. What I'm going to do is something completely different here, and I'm going to tell you about what's really happening in the economy and in the market right now, and I call it the Biden boom bust. And I'm going to give you the exact statistics. You're going to understand reality on another level. In addition, what I'm going to do is give you a free gift at the end of the presentation that is worth thousands. And by the way, I'm not going to pitch you anything. I don't want you to buy anything in this presentation. All right, so that's highly unusual as well, right? All right, let's get right into it. So first I need to give you, just if it's just okay with you, I'm going to give you a little bit of my background so you know that I might know a little bit about the subject, okay? I'm not making it up here. So that was a picture of me. You don't need that. I manage the #1 mutual fund in America, according to Morningstar. I managed the #1 global macro hedge fund according to AltVest for 3 years. I wrote the #1 performing newsletter that was 5 years, according to Hulbert Digest. I've written 10 books. Here's 2 of my most recent books. I've been on the cover of magazines, and Timers Digest voted me the #1 gold and bond market timer 3 years in a row. Been on TV over 1,000 times. I've really the most sought after investment trainer in the world. I've taught over 1 million people some of my trading techniques. Here I am in front of 2,500 people. Here is, sometimes my crowd gets a little anxious. They go a little crazy. What can I say? There we go. I don't know, that's like 1,000 people, 800, I don't know, something like that. And but the most important thing, or the second most important thing, is I really trade every single day, and I've been doing it now for 50 years. I've been a professional in this industry, and I trade every single day. This is how I make my living. I have a small business, but that doesn't make me any money. The way I make my money is I trade. I eat my own dog food. But what I'm most proud of is I help people learn how to be financially free. That's my business mission. Okay, let's get into the current situation of where we are in the economy and the market. We have the loosest monetary policy since the Civil War. Now, if you remember, you were probably around in the Civil War, and you probably remember that loose monetary policy that led to hyperinflation. But we are now, as we speak, and I'll show you the statistics in just a second, our current situation is we are in the loosest monetary policy since the Civil War. So the hyperinflation we saw in the 70s, we're looser than that. We have the loosest fiscal policy ever. Even in World War II, our fiscal policy was tighter than it is now. The government is spending money right now at a level it has never led, it ever has, even in World War II, which was the previous high. We've just beat that record now. We have the loosest monetary policy in developed countries ever. So I'm talking about, Japan and England and Germany, and, I'm not talking about banana republics. They've had looser monetary policy, but not in a developed country ever. These are dramatic things. I love it because they say, well, I wonder what will happen with this experiment that we're doing on monetary and fiscal policy in the United States. We already know what's going to happen, and I'm showing it to you in this presentation. We have the loosest fiscal policy in developed countries ever. We also have a number of anti-business policies coming. Some have already been kicked in, such as banning fracking on federal lands. But in addition, we're going to see a continuation of those. The Biden policy is to be anti-business. So I don't think there's any controversy that that's their policy. Also, no controversy that we're going to have higher taxes. We don't know exactly how much higher right now because it hasn't gone through Congress and so on and so forth, but we'll probably see much higher capital gains taxes, income taxes, and corporate taxes. There's not much left. Property taxes and sales taxes are the only ones left. But on the federal government side, we're going to be having significantly higher. And we're talking about 30, 40, 50% higher than where we are now. So this is the situation we're in right now. Well, let's take a look. This is also the biggest intrusion of the federal government since the Civil War. Even FDR did not actually intrude into the private sector as much as the Biden administration is right now. Now, I'm saying all these things so you have perspective, so you understand that this is a dramatic change in policy compared to previous administrations going back 150 years. Of course, in the Civil War, the government intruded. It suspended habeas corpus in the Union. The South turned into a socialized country, a socialism. They instituted socialism. But the North also instituted a lot of intrusion, mainly on the political speech. There was no political speech during the Civil War, et cetera, et cetera. So here's this current situation. This is dramatic. I've been in this market, as I say, for 50 years, and this is the most dramatic monetary and fiscal policy I have ever experienced, including the 1970s, 80s, 90s, 2000, and now here in the 2020s. So monetary policy. Let's take a look at this. When I said the loosest monetary policy, this chart just goes back to 1960, but you can see that we had a big increase in the 2008 recession, a big increase. But now we've dramatically blown through that. Starting under Trump and continuing under Biden, the Fed has dramatically increased money supply. We're talking trillions of dollars. On a percentage basis, also extremely high. And of course, their reason for doing this is to support the economy due to the COVID crisis. Okay. By the way, I'm not going to debate whether these ideas are good or not that Trump or Biden did. That's not my purpose. My job is to make money from this information. What their policies are, that's for you to debate with your friends as to whether it's a good idea or a bad idea. Not my job. My job is to make money trading. Let's carry on. Monetary policy number 2. Here we go. One of the things is when we look, if we go back, we look here, this is monetary base. When we see this ratcheting up, we know that does mean that we're going to have inflation, maybe even hyperinflation, which is considered above 20%. But what a lot of the Johnny One Notes, the gold bug guys, what they always miss is that there's another part to the monetary policy. And I'll get to that in 1 second. Inflation is always a monetary phenomenon. You know, politicians like to tell us, oh, well, you know, there's oil prices went up because those damn speculators. You know, they'll say stuff like that, but, you know, they're idiots and they don't know what they're talking about. Because if the Fed is not increasing money supply, then if the price of oil goes up, then the price of something else has to go down because there's no additional money in society. But if the Fed pumps in money and the price of oil goes up, then it becomes inflationary because the money is there to pay for it. So I'm going to show you why I think inflation is going to come back at a very dramatic rate. But we have to be realistic. This is called the velocity of money. You see, inflation is the amount of money times the amount that it's spent. And as you can see, we've been in a bear market on velocity. That is to say, people are taking in $1 from their paycheck and they're not spending it as quickly as they used to. And if you look very closely at the far right-hand side of the chart, in the COVID crisis, velocity collapsed. Now, when velocity goes down, that reduces inflation. So that's a good thing. Inflation's bad for society. But the problem is, it looks like the decline in velocity is over. Look down at the very lower right-hand side, and you can see we bounced up, and it's now been several months since velocity was declining. It's now stable, which means that the full effect of the monetary stimulus is going to flood through the economy. Velocity is not going to offset any of it anymore. This is a danger sign. The point, inflation is coming back bigly, all right? And that's going to affect all markets. Fiscal policy, another crazy thing that we're doing. Fiscal policy, this shows federal surpluses or deficits. And you can see that 1994 was the last time we ran an annual surplus. Then you can see that in 2008, we ran big deficits and we ran them for years. Then we started to get some surpluses in the 2010s. But look at what happened when COVID hit. A year ago, the federal deficit plunged to, that's 800,000 per month, okay? But it was basically trillions of dollars. On the far right-hand side of the chart, you can see that it's plunging again. Now, the Biden administration has proposed $6 trillion of new spending. So the sharp decline that we're seeing in the deficit, that's the beginning of the decline, and we're going to break the low that we made last year, and plunge to even lower numbers. On a monthly basis, we're going to be over $1 trillion a month in deficit. Now, to also put this in perspective, the new spending that the administration is proposing, and it has not been passed yet, it has to go through Congress, they've proposed $6 trillion. To put it in perspective, a couple of years ago, the whole federal budget was $4.5 trillion. So they're over doubling the size of the federal government in 6 months, a year, pick a number. It's a dramatic change, dramatic. So the big deficits are coming. So we have the loosest monetary policy, and this shows the loosest fiscal policy. This is the federal total budget debt. This is the whole debt going back to the 1960s. And you can see in 2008, it kind of hooked up. It kind of accelerated there. But then we stayed at that accelerated level. And now, starting with COVID last year, it's accelerated again. This is just another way of looking at the previous chart, but this is the cumulative effect of the previous chart. Massive debt. And massive debt has to be paid off eventually. This is another way of looking at it. Federal debt as a percentage of gross domestic product, GDP. This goes once again back to the 1960s, so it's recent information. I put a red line on this chart at 100%, where total debt as a percentage of our GDP is at 100% with that red line. And we passed it in the mid 2000s. It looks like around 2015, 2016, something like that. But when COVID hit, it spiked up from just over 100% all the way up to about 130%. Now, why is this important? Well, economists, who I have low respect for, they say that once we get above 100%, that damages growth in a society. And we don't know if it's 100% or 95% or 105. Nobody really knows that because there's not a lot of experience. But what we do know is at 130%, that kills the economy, because now we're working to pay the interest off. We're working to pay the principal off rather than working for growth. We're not investing in growth. We're investing in paying off old consumption. And remember, the federal government only consumes wealth. It never creates wealth. So what we have here, and let's take a look. We can look at the empirical evidence. And we can say, well, what happens to countries where the debt becomes over 130%? They all fail. They all fail. The only one that has not failed yet is Japan. Japan has almost 200% debt. China, by the way, is over 130% right now. But what happens is that the economies grind to a halt because, as I say, all the money is being used to pay off old debt, and that just simply does not work, okay? Simply does not work. So this is something that's going to be very, very important as we go forward, okay? Very, very important as we go forward, this number right here. Now, when I say that Japan has hit over 200% and they haven't failed, let's not forget they've been in a recession since 1990. Okay, so maybe that is failure. Maybe that is failure. But that is exactly what's going to happen to the United States because of this dramatic increase in debt. It's always happened in every country, every time. I don't think that the US will be an exception to that. Okay, let's take a look at some more things. Taxes. This is another dramatic change in policy that's going to have a big impact going forward. And I'll explain it very clearly. So we're going to have higher income taxes. That the Biden administration has made that very, very clear. There's a simple economic principle. If you raise taxes on something, you get less of it. If you lower taxes on something, you get more of it. It's an economic principle. So if we raise income taxes, there will be less income in society, or at least there will be less income reported to the IRS. Why? Because if income taxes go up, then people go into the black economy more. They start wanting cash. They start wanting Bitcoin. Okay, this higher income taxes is going to boost the demand for Bitcoin because people will want anonymous transactions. They'll go to gold. They'll go to, but as I say, the most common thing they'll do is go to cash, or maybe they just won't work. But the point is, it doesn't increase tax revenue. It decreases income by the amount that the taxes go up. They offset. Okay. So that's the key thing here. All right. So higher taxes means less income in a society. And if there's less income, that means that, we're going to have a slower economy. Now, and we'll get to this in just a second. Let's carry on. We're going to have higher corporate taxes. That one's a done deal. Well, here's the silly thing. Who pays those corporate taxes? Well, the corporations pay the taxes. No, they don't. Corporations pass on the higher taxes, and their workers and their customers pay the taxes. Corporations are just a pass-through. We pay higher prices to the corporation, and then they use that money to pay their corporate taxes. So it's a pass-through to their customers. Their workers don't get wage hikes as much because the corporations take it from their workers and pay it to the government. So the workers and the consumers are the ones that pay the taxes, not the corporations. The corporations just collect the taxes, but they don't pay them. Their profits will be the same. This is the killer one. Higher capital gains. We're talking about doubling of capital gains taxes. If you tax capital gains higher, you get less capital gains. So what does that mean? It means that the stock market's going to crash. Because why would anybody buy stocks when you end up paying more in capital gains tax than income taxes? That's just insane. So capital gains taxes provide a function in society, and the function is to attract capital for business investment. Business investment is a leading indicator of wage rates, because as businesses invest, they increase productivity, which allows them to pay their workers more money. So higher capital gains taxes will reduce wages. It will reduce the value of all capital goods. If you tax a capital higher, the value of that capital goes down, which means machine tools, the value of machine tools that you own, your factories, they go down in value. And guess what? Stocks go down in values because stocks represent capital in our society. Okay, they're not a public capital, shall we say. So member says, here comes hyperinflation similar to the Weimar Republic and Zimbabwe. Look, it could all change. Some of these things have yet to be passed, but we need to be aware of them so we can make money as traders. That's the key. We need to be able to make money from these things. So higher capital gains means lower stock prices by definition, really. Okay, now at the same time that the government and the Fed are stimulating the economy through the most massive fiscal and monetary stimulus ever in history, at the same time that's going on, what else is going on? Oh, that's right, they're choking off supply. So let me get this straight. More money chasing fewer goods. Oh, that's right, that's the definition of inflation. So how are they choking off goods? Well, right now, they're paying people to be unemployed. Right now, if you're earning less than $32,000 a year, you're better off quitting your job because unemployment will pay you more than $32,000. So people are being paid to be unemployed, which is causing a shortage of labor. If there's a shortage of labor, that means the price of labor, wages, have to go up in order to attract people. And specifically, they have to go up above $32,000. Okay, so that sounds good. I like the idea of everybody getting paid more. That sounds really good. I like people getting paid lots more money. But here's the thing. What if the labor that they're providing is worth $25,000? If a company has to pay $35,000 to hire somebody who's only producing $25,000 of value, the company goes bankrupt. So they're not going to do it. They're not going to hire $25,000 value employees for $35,000. They can't do it. They can't afford it. And I'm really talking about jobs where they're unskilled labor. Okay, so beginning jobs, working at McDonald's, that kind of thing, restaurant, hospitality are often low-paying jobs that companies simply cannot afford to pay higher wages. So we're choking off the supply right now of people being employed by paying them to be unemployed. We now have more jobs available than people who are looking for jobs. This is what happened in the late era of the Trump administration. We ended up with more, first time in American history, there was more jobs being advertised than people to work there. Same thing happening again, but for a different reason. In addition, we're saying, you know what? We don't want as much energy anymore. The Biden administration has already banned fracking or drilling on federal land. So places like eastern New Mexico, see you later. They're not going to. Now, Texas still has a lot of private land. So we're going to continue to see fracking or drilling there. But we've stopped fracking or drilling in Nevada, which is like basically completely owned by the federal government. Eastern New Mexico, a lot of Utah, Montana, Wyoming, etc. So we're going to choke off the supply of energy. So that means higher energy prices because there'll be less supply. Greater regulations chokes off supply as well. If it costs me longer to get a permit to do something, then I can't supply that good. And for, let's say, if it used to take 6 months and now it takes a year, I can't supply my product for an extra 6 months. So I'm choking off supply. This is a factor that's being spoken of very, very little. But choking off supply is a serious problem. $15 minimum wage. This goes back to paying people to be unemployed. If a person is paid $15, but they're only producing $10 of value, companies can't do that. They go belly up. That's a sure way to go bankrupt, is to paying more than the value of the labor. Look, we all want everybody to make more money. I wish everybody was making $100 an hour, but they have to produce $100 worth of value or they kill the company and then they don't get a job at all. So the $15 minimum wage, which is not a law but applies to all federal projects now, is going to choke off the supply of labor. Okay, so let's take a look at some of the scenarios that's going to happen, because we want to, the final purpose of this presentation is to figure out how we can make some money from all of this. But now you have an idea. We're seeing massive stimulus, and at the same time, we're choking off the supply. Now, back in 2008, we had massive stimulus, but we didn't choke off the supply. The stimulus wasn't as much, and the supply wasn't choked off as much. Velocity also collapsed then. Now it's stabilizing. So these factors are very different from 2008. 2008 did not lead to high inflation. This time around, it will, because the conditions that helped damp down inflation in 2008 are no longer there now. So let's take a look. The economy will boom. Till when? I'll say till at least fall. The boom is going to come on the back of the excess capacity we have in society left over from the COVID collapse. When COVID collapsed, we shut down the economy, which means that there's still a lot of excess capacity. I'm doing this broadcast from Las Vegas. Trust me, the casinos have lots of excess capacity right now, okay? So they can keep adding more business, but they'll be at full capacity in a month. So we will boom over the short term. And I'm thinking around fall. Of course, the timing is a little bit hesitant right now. Then we're going to start to grow slowly. We won't have 6% growth in GDP. We'll have 1% growth in GDP when all of these things that we just talked about start to bite, start to slow the economy, and we'll start to see 1% growth. Inflation will move above 5% this year, no problem at all. We just saw producer price index dramatically higher. We even have CPI was released earlier this week at over 4%. So when I say it's going to be above 5%, that's like no prediction at all. But we're going to start to move towards 10% by the end of the year. We're then early, like right now, we're going to see the stock market continue to rally. The massive stimulus of the Fed and the government is going to continue to be a backstop. We saw that companies are going to do buybacks. They're planning to do buybacks at record levels this year. That will reduce the supply of stocks, which means the stock market will rally until late summer, early fall, and then I'm looking for a, let's call it a 10% correction. Not a major bear market. That's next year, not this year. This year, we get the shakeout breakout. We get everybody saying, oh my God, this is the end of the world. We do that in August or September. Everybody freaks out thinking it's a big bear market. They're going to be caught with their pants down. And guess what? It'll start to rally again. We're seeing gold start to rally now as inflation comes back and real interest rates fall. People don't understand the gold market. Real interest rates dominate, and the Indian wedding season. Hopefully, right now, there's not going to be an Indian wedding season again. That reduces the demand of gold by a lot. 50% of the demand for gold comes from Indians for weddings. People don't realize this. But real interest rates are the other factor. They're going to start to help boosting gold into a sluggish bull market. Commodities will boom. They're already booming. They're going to continue to boom. I'm long commodities. You got to be buying commodities, commodity type stocks, things like that right now. Okay, phase two. That's phase one. That's really kind of this year. But risk is dramatically increasing throughout all of society. See, when the Fed reduces interest rates to zero, it induces people to gamble more. So we see the rise of things like NFTs. We see risky stocks outperforming steady stocks. We start to see just, zombie companies. We're at a record level of zombie companies because they can borrow money cheaply. If I can borrow money cheaply, it makes some projects which at high interest rates don't make any sense. It makes them sense. But if the Fed ever raises interest rates ever again in my lifetime, it collapses those particular projects. So the Fed is increasing risk dramatically. And since every country is dramatically easing monetary policy, risk is increasing around the world. At some point, probably next year, the Fed will start to tighten. And that will create a wave of bankruptcy because of all the borrowing that was done based on zero interest rates now becomes uneconomic at even 2%. And that then gives us a major economic crash in 2022, a stock market crash in late 2022. Gold goes down at first because people sell gold in order to make their margin calls on their stocks, and then it rallies after that. So that gives a great buying opportunities. And then, of course, commodities crash because now there's no money to buy them or to really store them. Now, the timing on this latter part of stuff, don't really know. But the fact is, we do know that risk is dramatically increasing. And as we increase risk, that increases the wave of bankruptcies, the crashes that come later. The greater the risk now, the greater the crash later. That is a truism that has always been true in human society. The Fed is creating the next depression right now. Federal government also doing that because they can't spend money at this level. It's impossible, okay? It creates too much what's called malinvestment in a society. This year, things are going to look great. That's the previous slide. Phase one, boom time. Phase two, not so hot. Okay, so how can I help you? Well, I put on a newsletter called Wall Street Winners, and I'm not even going to sell it. I won't even let you buy it. How's that for a pitch? But every single week, I'm going to tell you about it, and I'm not selling it to you. It's a weekly 20-minute video briefing. It comes out every Sunday night. I give you an online trade sheet with all the trades, and the trades are specific. I say buy here, sell there. This is not, some vague thing like I think it's going to go higher. But what I do is I do unique analysis. I've given you a very brief look at some of the unique analysis that I do. But what's in Wall Street Winners is really even more unique. It's proprietary. Nobody uses these forms of analysis at all, which is why, as I showed you before, we had the #1 performing newsletter when I used to participate in all those contests. We crushed everybody. Our track record was better than everybody by a long shot. So why? Because we do things completely differently. Because we use forms of analysis that nobody else uses in the world. First of all, on the economy, I've shown you a small slice of that, and I haven't really shown you any of the super unique or what I call the super tricky indicators. But what those super tricky indicators is tell you what's really going on in the world, not what's in the newspaper, not what's on CNBC. That's all blah, blah, blah. The key is what's really going on. So I show you who's doing what to whom in a unique way. But of course, more importantly is how can we make money from that? Like I say, it's not my job to decide, are the Biden or Trump policies good policies or bad policy? Don't care. Not my job. I may have an opinion on it, but it doesn't affect my trading because my trading is to make money for me. And guess what? I don't want to eat oatmeal next month. I want to eat steak. Got it? So I need to make a lot of money. So we need to know how to profit from all these things, not discuss the politics. That's boring. Making money is not boring. So we then create specific, actionable trade recommendations for stocks, bonds, dollar, Bitcoin, commodities, etc., etc., etc. We use totally unique indicators and analysis. What you see in this newsletter, you cannot find anywhere else in the world. That's why we have, when people subscribe to Wall Street Winners, they never cancel. They never cancel. Because where else are they going to get this information? There isn't any place to get this information. I've been spending now over 35 years developing these unique indicators. All right, let's carry on. So I'm going to wrap up my presentation here early. So Annie, pay attention. But here's the deal. I'm going to give you a free 1-month gift to Wall Street Winners. It's that simple. If you're on this webinar, when Anna sends me the email, I'm going to send you a free month because I need you to see what's really going on in detail. In this short presentation, I can't go into super detail. So instead, I want to give you 4 weeks of Wall Street Winners so that you can really see what's really going on in the economy today, not the blah, 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 the reality. It's a weekly reality check on what's really going on. So all I'm going to do is I'm just going to give you a free 1-month gift. Hey, if you want to subscribe, great. If you don't want to subscribe, fine. You're not going to hurt my feelings. I don't need your money. So we're just going to, everybody who's on this webinar, we're just going to, when they send us your email, we'll send you a free subscription to that. And I hope that you use it to make a tremendous amount of money. If you don't get it for whatever reason, by Monday, the current issue comes out Sunday, then send me an email at support@wealthbuilderllc.com. That's not 11C, it's LLC.com, support@wealthbuilderllc, and we'll make sure you get the current issue. It's a video newsletter, so we just send you a link to a private site where you can view the email, or view the video, I should say. All right, everybody. I'm going to let you go. I want you to ponder this all. Don't panic. We're going to be there to help you get you through this to make money in the boom period and in the bust period. Bust periods are great because guess what? You make money faster when the market busts than you do when it booms. But here's the deal. There's an old saying that the bulls take the stairs and the bears take the elevator. So we make money slowly during the boom times. We make it really fast when the market collapses, which I think is going to come as early as next year. So with that, I'm going to leave you here. Any questions at all? The cost of the newsletter, someone's saying, is $67 a month, so it's a peanut considering what you get. As I say, totally unique. Your mind is going to be blown at what you're going to see reality in a new way that you've never seen before once you get these free copies that I'm going to send to you. And you know what? If you're a day trader, it's going to be useless to you. If you're a position trader, you're going to have to subscribe. I'm so convinced of it, I'm going to give it to you for free. All right, everybody, we will talk to you later. Thanks very much. Anna, I'm going to send it back to you.
Thank you so much, Courtney. Great presentation. Let me check for questions. What is the cost of newsletter?
I already answered that one.
Oh, sorry for that, duplicated.
Any other questions? I don't think so. Oh, here we
Does
go.
everyone
get the free
get
trial?
free
Yes.
trial?
Everyone gets the free trial. Listen, let me stop 1 second. My business mission is to help change people's lives. I'm not a charity, so I want to break even. But I can do stupid things like give you a 1 month free trial to this publication because I want to help people. We give away a lot of free information. If you've been on my previous presentations here, I've given away profitable trading techniques because my business mission is to help people take money. In 2007, I got into this business. I've been a professional trader, money manager my whole career. And I had retired in the year 2000. And what happened was around 2007, and I traveled all over the world. I lived a couple of years in London. I lived a year in Geneva. I moved to Singapore. I had a great life. But in 2007, something started to bug me. And I'm going to ask you all who are on this, I'm going to ask you the question that I was thinking about. Do you think your bank is looking out for your interests? Do you think your broker cares about you? The answer, of course, is no, they don't. They don't care at all. Now, I worked in the financial community for years. I lived in New York City for 25 years working for big corporations, big banks, big global banks. And I realized that there was nobody really caring. So I said, I'm going to start a business where I can train people on how to control their money and grow their money. And I don't need to make money from the company because I make money trading. That's how I make my living. So that's why we do what we do. It's a completely different approach. So we do stupid things like give away free subscriptions or free techniques. I don't care. My business mission is that you make money. That's my business mission. I don't want to lose money. Like I say, I'm not trying to lose money, but breaking even, fine with me. Okay, Eric G says, do you think Bitcoin will still rise alongside gold and other commodities? Here's the problem. Bitcoin is a fiat currency. It's air, just like the US dollar is air. US dollar is air. Bitcoin is air too. It's backed by nothing. So I can't be excited about crypto as an alternative. The advantage that the US dollar has is that it's called legal tender and everybody takes it. So right now, the US dollar is far superior to Bitcoin because I can spend it and everybody takes it. In the final analysis, of course, all currencies go to zero and the US dollar is on its way to zero, that's for sure. Adams Williams says, what is the favorite commodity over the long term? I think what we want short term is I'm particularly keen on industrial metals. So copper, we see that tin is making the record highest price in history right now. That's pretty incredible. But we see that corn has doubled pretty much all across the board. But I particularly like the industrial metals a lot. And then I think the precious metals will do well once inflation really hits people's consciousness and real interest rates collapse. All right, member says main element of the market crash will be the COVID vax is a scam. You know, look, I don't know if it's a scam or not. Once again, not my job. I'm not a biologist. I am a guy who makes money trading. So if it's a scam, that's not going to be good for the economy, and I'll make even more money. That's the way I look at it. What is holding silver back? That's a really good question. Silver is both an industrial and a precious metal, and precious metals have not done well. Platinum's not up very strong. Gold's not up very strong. I mean, they've started to move up a little bit, but that's after pretty long, you know, months and months of bearish price action. So they haven't done all that well recently. Silver has been held down by the precious metals aspect. The pure industrial metals like copper, tin, zinc, etc., have been booming. We're now starting to see the precious metals start to move up because inflation is starting to get into people's consciousness. Real interest rates are declining. But as I also mentioned, 50% of the demand for gold is Indian weddings, and that's holding back precious metals as well. That's why I like the industrials better right now. Yeah, and member says Indian gold buying this summer will be down because of the so-called COVID deaths. Yes, that's absolutely true. But remember that about most of the demand for gold in India comes in the fall with the wedding season, and there was no real wedding season last year, and there may not be another one this year. So that'll be 2 years in a row where the demand for gold will have declined a lot. Okay, member, send that email. That's all I can say. All right, any other questions? Okay, awesome, everybody. We will see you in the next issue of Wall Street Winners. And now let me turn it back over to Anna. Thanks very much, everybody.
Okay, very good. Excellent. Greetings, everyone. Oh, wow, we've got a good group here. Lots of people. All right, so you should be able to see my slide that says, welcome to the webinar, how to time your trade entries for big moves and avoid getting stopped out. Let me know if you don't see that. Anybody in the chat or question box, go ahead. I'm just pulling up my questions box right now so I can see any questions that you have. Look forward to interacting with you here a little bit. Looks good, Eric. All right, thank you very much. Appreciate that. All right, so without any further ado, let us do it. So yeah, well, here's my ugly mug. I'm Dr. Barry Burns, owner and founder of Top Dog Trading. I wrote the book Trend Trading for Dummies by Wiley & Sons. Received many, gosh, every year I get Reader's Choice Awards for my trading courses from Stocks and Commodities magazine. And that means a lot to me because that is voted on by, well, other traders, people just like you, and that's what really matters. So I've helped other authors, have been included and highlighted as a successful trader in several other books. And I work with big companies like NinjaTrader, the Chicago Mercantile Exchange, eSignal, Metastock, the York Exchange, and it goes on and on and on and on. Oh, I wanted to let you know, by the way, I've got nothing for sale today, so I'm going to just say that right at the beginning. So nothing, you can't even buy anything from me if you wanted to. You could get down on your knees and say, Barry, please sell me something. And I'll say, sorry, got nothing to sell you. So everything I'll do, I will give you some freebies here at the end. I got some free stuff to give you after we finish this that you can take and learn more if you would like. But also have some other freebies out there. So I just do a podcast. By the way, doing a new one tomorrow. I'm interviewing a gentleman who is a trading psychologist. And that is tomorrow. So, but we've got a lot of good sessions on there already. So feel free to check out Top Dog Trading Podcast. It's anywhere podcasts are. That's an example of iTunes. Gosh, we're pretty good. We got ahead of Jim Cramer. Seriously, wow. Okay, that's pretty good. So, but I didn't do that. You guys did that, right? That's by, I don't know how they do the algo on that, but anyway, there's no way I can make that happen. So important disclaimer, and I'm sure you know with a multi-speaker event like this, you've seen this before, but I also know on these multi-speaker events, people come and go, attendees come and go. So just to make sure that everybody's seeing this, I'm not going to read this out loud for you, but it's very important that you read it, and you can look at it on our websites and so forth, because if you think about it, people think of this as just legalese, I think, but it's not just legalese. It is what the regulators have done. Research. This is where your education begins. So very important that you read this, and this will help you avoid all the hype out there. This is the anti-hype of trading education. And so even if you've been a trader for a while, really important to go back and use this as the foundation for your trading into the future. Okay, so today I'm going to talk about, cycles. We're going to talk about a very specific type of cycle today. But first, I just want to address cycles in general. And, well, our previous speaker addressed that as well quite a bit. But there's many different types of cycles. So you got your seasonal or calendar cycles, and that's just based on the calendar. So, and also, retail, like around December is when the big retail cycle happens for retail companies. But you got to be careful because, yeah, that's when it all occurs for, the holidays. But actually, it starts months before that as people start buying presents for the holidays. So it's not when the event occurs that begins the market action. It's before that as the market prepares for that day or that season. Vacations. People generally take vacations in the summer. Well, at least they used to back in the pre-COVID days. And so a lot of companies associated with the travel industry, the summer, that would be their hot time when they make a lot of money. And you get the idea. Now, we also have up-down cycles. These are your oscillations in the market, as it's often called, swing highs, swing lows, swing high, swing low. And then a really important one, not many people talk about, is order chaos cycles. I hardly ever hear anybody talk about the order chaos cycles, but these are really, really, really important. So, and you might have experienced this in your trading journey if you've made some money and then you've given some back. Made some money, given some back. Made some more money and given even more back. I know I went through a period of time in my journey where that was happening. And what's happening there is, well, there's a famous book you probably heard of called Random Walk Down Wall Street. They posit that the market's very efficient and everything that can be known about the market is already known. It's priced into the market. And so if you follow that book literally, then, well, basically they're saying you can't make any money trading. And the only problem with that is, and by the way, they make a really, really good argument. It's a good book. But the problem is that there's a lot of traders who do consistently make money year after year and even decade after decade. And so as I looked at both sides, I studied both sides of this issue, I came up with, I think I see what's happening. Most of the time, the market is chaotic. It is random walk down Wall Street. But every once in a while, the market gets into an orderly movement. And this is where you see your stair-step patterns, for example, higher high, higher low, higher high, higher low, accumulation, distribution, and the market gets into an orderly pattern. Those are the times, cycle equals time, those are the times you want to trade. The rest of the time, you want to just stay out because there are no high probability trades to be had. And this is why so many people lose money. They're trading during times, they might even have a good trading system, and they lose money because they don't even know they have a good trading system, simply because they're trading during chaotic periods of time or chaotic cycles where no method would give them a high probability trade setup. So it's a matter of knowing when these cycles occur, when you're in an orderly cycle, and only trading then. And then you get your coupling, uncoupling cycles. This is very well known when various sectors, markets, indices correlate and when they get uncorrelated. These provide some of the best opportunities if you can get into that time when they start correlating again at early or when they get uncorrelated early. And the final type of cycle that we'll share today, and this is the one we're going to focus on today, is volatility cycles. And so what this one means is that the markets go through low volatility periods and then high volatility periods, followed by another low volatility period. And this can be demonstrated, well, low volatility would be things like triangles, wedges, Bollinger Band squeezes, etc. High volatility would be just the opposite. In fact, let's just bring up a little example here so it's clear for everybody, because this is going to be the foundation for the rest of our presentation today. So we're going to use high volatility cycle, or we're going to use volatility cycles, I should say, to catch big moves. Big moves means a big range in the market, any given period of time. Again, if you're not quite clear on what cycles are, it's just a period of time. So for this one here, we've got high volatility, meaning it goes from a low to a high, a wide range of price action. And if you use a geometric tool like a rectangle here, it will look like a tall rectangle that is more generally narrow range in time. And then we go into a low volatility cycle, low volatility period of time, where the price range is not as great. Okay, these are not as good. Even if you make a successful trade here, your risk reward is not as good, right? Because your reward is not as good. Here, the reward is bigger. This is what we want. We want to catch these puppies. So some of these patterns that you can trade: Bollinger Band squeezes, contracting channels, wedges, triangles, moving average convergences. You'll notice when I talk about patterns to trade, these are all low volatility patterns. So one of the questions is, well, what patterns to trade, how early or late to enter, which direction to trade, and when exactly to enter and when exactly to exit. So that's what we're going to focus on today, and especially we're going to focus on these three patterns: moving average convergences, triangles, and detachment from equilibrium. Now, before we get into these three patterns, that's what we're going to do. We're going to spend the rest of our time giving you examples of these three patterns that you can trade. Here's one of the biggest mistakes I see people make going into this type of trading. They want to catch those big moves. Great, we all do. And so what they do is they scan for high volatility markets. That's the mistake. Too late. By the time that a market has made a big move and it's made it long enough in order for it to show up on a scan, in other words, there's been enough data, enough time. Again, a lot of this is all about timing. So by the time that enough time has gone through to create enough data to cause a scan to register, yep, this is a high volatility market. Remember, volatility goes through cycles. And if you are catching that on a scan on a high volatility setup, that cycle has already not only already begun, you're already well into it. And now the problem is what's going to follow is a low volatility period of time. And so this is why people scan for high volatility markets, or just say markets that are really moving. I want to catch markets that are really moving. By the time they're moving, you're too late. You're too late to the party, because what's going to happen is a low volatility time is going to follow up. And that's the worst way to actually catch high volatility moves. Okay, so let's show you these three very clear techniques based on technical analysis. There's more, but today we're going to cover three. So pattern one is called moving averages convergences. So here are the moving averages I use, just spelled it right out there: the 15 EMA, 50 SMA, 100 SMA, and 200 SMA. Now, let me just state clearly, first of all, there's nothing magic about these moving averages. People always ask me, what do I use? So that's what I use. You don't necessarily have to use those, but here is what is very important to make this setup work. You need to have a very short-term moving average, and you have to have a very long-term moving average, a slow moving average. So you got to have at least that for this pattern to set up correctly. All right, now I use these same four moving averages on all my charts, whether it's a daily chart, a monthly chart, a 1 minute chart, a 144 tick chart, an hourly chart, whatever. And I do that, and I recommend you do that as well. Use the same moving averages on your charts, all your charts, so all your time frames, so that you get pattern recognition in your brain. If you keep changing indicators and moving averages and all that kind of stuff in each one of your charts, you never allow your brain to develop enough pattern recognition through a lot of repetition. So the recognition comes through the repetition in order for you to just be able to have your brain recognize after a long, many data points, many samples, that your brain just starts seeing those patterns without you having to think about it too hard. That's when you move to a next level of trading. That's when it becomes almost intuitive, natural. It just flows. So don't keep changing your charts around. big amateur mistake is they're always just trying new things. Even when they got a good system, they're always, oh, let me throw this new indicator on here today. Let me throw these different moving averages on there today. Okay, you got to go through that trial period. I get it, to find a good trading system that works for you. Absolutely, I'm not discouraging that. I'm just saying once you find the setups that you like on your charts, the structure, the indicators, the moving averages, whatever, then just stick with it. You will do yourself a disservice if you then continue trying to optimize, over-optimize. You will actually do the opposite. Okay, so the pattern is very, very simple. All we're doing is looking for these 4 moving averages to cluster together, just like this. So what does that literally mean when those 4 moving averages cluster together? That means that price has not really had any significant change over the last 15 bars, 50 bars, 100 bars, or 200 bars. So that is a way of measuring low volatility. And that's when you want to start looking at in this case, we've got Apple 3-minute. That doesn't matter, by the way. Want to make that clear. This pattern, based on moving averages, you can use this on Forex, gold, crude, commodities. You can use it on stocks, indexes, futures. Really doesn't matter. It's just a matter of showing, again, the energy of high volatility, low volatility markets. And again, any time frame. There's no magic there's no real reason. I even put a 3-minute chart up there. I had to put something, so I did that. If I didn't put Apple 3 minutes, somebody would say, or if I put like a Euro 60 minutes, somebody would say, well, why didn't you put an Apple 3-minute? So, okay, just want to make that clear. This is a universal trade setup. So we got this as our signal right here now I'm not going to trade that right away, but this is what I would scan for, in other words, because I want to scan for the low volatility markets and then get in on that new cycle of a high volatility market like that. And by the way, these high volatility moves, these big moves, I usually don't hold on to them for very long. Remember, the high probability pattern for them is that rectangle. So I don't expect them to last a long time, especially if they move very parabolic like this. So generally when they move very parabolic like this, it's not going to last that long. Of course, there's exceptions, but we're not trading the exception, we're trading the rule. We want to trade what works most of the time. I just take my money and run. And I find that a lot of traders are worried about getting out of too soon. There's a time to where, yes, that is not optimal, especially in a more like sine wave, gradual stair-step pattern. You can generally hold on to those longer. So, but hey, I'd rather get out early. Now see here we have, first of all, 5 waves. That's the average trend length. Here we've got a double cluster of resistance. There's another level of resistance. We just get a wick up here. I'm just going to get out right there. Now, did it go further? I don't even remember, but I don't care. Because my attitude would be, all right, if we trade this bar right here, this big, great candlestick pattern here, okay, boom, catch a lot of money in a very short period of time. Okay, if I'm trading options on this, the leverage is fantastic, right? And so I just made some good money, good percentage return. And you're always better off professionals get in early, amateurs get in late. That is a basic universal principle. So I'm looking to get in early, and I'm not going to get greedy, and I'm not going to have trader's remorse. What trader's remorse means is when people say, oh, I got out here, but then it kept going higher. I don't care if it went higher. I don't care, because nobody knows when that move is going to end. Believe me, nobody knows. Warren Buffett doesn't know. I don't know. You don't know. Anna doesn't know. Nobody knows. Okay. So you want to take the money, honey. I had a adopted grandmother who came from a big, big, big family. And it was like, I think she was the 10th child in that family. And so they'd all be gathered around a big table, and she'd say, had all the food on the table. People would pass the dishes around in a circle. And she said one time, I thought, they passed the muffins. Literally, this is what she said. They passed the muffins. And I'm like, yeah, I'm not really wanting a muffin right now. Maybe I'll have the muffin later. Well, later came and the dinner, and she decided she wanted a muffin, and all the muffins were gone. 10 kids. The muffins are going to go. And so she told me, Barry, principle of life, take the muffins when they're passed. You might not want that muffin now. You might not even want it later, but take it while it's available, right? Bird in the hand kind of thing. So in trading, how that applies and what I learned was that, okay, this is the high probability exit. Now I can take that money. I'm not really losing anything if I take my exit there and the market keeps going up. And you want to know why? And this is what helps me deal with trader's remorse, because I can take that same money now that's now in cash and put it into another opportunity, another stock, another forex pair, another whatever, futures contract, and get into another high probability trade. And the probability of that trade working, because it's early in a new setup, is higher than this one continuing. Remember, the trend is your friend until the end. So that means the longer the trend continues, the higher the probability it will end. So at this point, this is no longer a high probability trade. So I could take that same money, put it into another trade that's early in a setup, and that same money now has a higher probability of continuing to make me more money than if I just held on here. So don't worry about being right. Don't worry, be happy. Okay, but very important principle. Right? So that's it. We look for this. We look out for, you can trade this two ways. You could either trade the breakout. We've got resistance here. You could say, okay, I'll wait for a nice breakout, or I prefer to trade inside the consolidation. I prefer to trade before the breakout. So for me, that's the puppy dog right there. And it has to do with the wave count, 1, 2, 3, failed 5, 4. And by the way, this is not Elliott wave. Yeah, I should make that clear. These are not Elliott wave counts. These are, Barry waves, for lack of a better term. I have my own way of counting waves because I don't impose a 5-wave structure. I let the market tell me how long it is in the trend. And the average Barry wave, the way I measure it, is 5. But it can do more. With Barry waves, it can do 7, 9, it can do 30 if it wants to. The market's going to do what it's going to do, and I just wanted an objective, rule-based way of measuring how many waves it is, and I wanted it to allow it to go beyond 5 because, again, I use those wave counts to tell me, all right, statistically, we've established that 5 is the average. Knowing that the trend is your friend until the end, I want something to measure. Well, how are we getting close to the end? How do we know that? And that's what I use Barry waves for. Anything beyond 5 is we're beyond the average, and therefore the probability of it ending are increasing. Okay, so let's go to pattern numero dos. Zwei, ni. That's Japanese. De, that's French. Dual, that's Korean. Pretty impressive. Pentilingual with the number 2. Oh yeah. I forgot to mention, I am a card-carrying dad of 2 beautiful daughters, and so I've got that card right in front of me. I can't show it to you because I don't have a webcam on, but I'm not afraid to use that card and do some dumb dad jokes. So hope you don't mind. All right, so this one is really, really, really awesome. I love this trade. I trade this all the time. One of my favorites. So triangle trades. All right, so triangles are defined as lower highs and higher lows. So we got that here. I drew in the lines for you. 2 traditional ways of trading triangles, and that is this. Number 1 would be purely the breakout of the bottom trend line, or the upper trend line if it's going up, of course. And the other one is waiting for what's called the throwback. It's not technically called a retrace. A retrace is in a trend. A throwback is in a triangle. So just to make sure you get your terminology right, because if you ask a professional trader and you call this a retrace, they're not going to know what you're talking about. Or they'll give you a wrong answer, but it's not that they're wrong, it's just that the question wasn't asked with the proper terminology. So problems with both of those. So, and advantages. There's advantages and disadvantages to each one, which is normal for trading. So the advantage of the breakout, if you just trade the breakout, when the market does break out of the triangle and just goes down to the center of the earth and dips into the magma there, that trade is great. That's the ideal scenario for just trading the breakout. The downside of trading the breakout is when this happens. Okay, it breaks out, hits the 50 moving average, goes back up, goes back down, makes a lower low, whoops, goes back up, breaks that high. So it turns into really an expanding triangle now. So we go from a symmetrical triangle to an expanding triangle, or some people call this a megaphone pattern. So takes out that low, takes out that high. This is like the worst of all worlds. If you took this breakout, this is where psychologically it becomes challenging. Oh my gosh, now it's just wiggling around. Do I stay in this or not? And you're seeing your P&L go red. Oh, then it goes green. Oh, then it goes red. And psychologically, that can be challenging to stay in. All right, and that it took an hour. So for an hour, over an hour. So for over an hour, are you able to stay into that psychologically? Plus, your money is not making money in real time. So that's the downside of just trading the pure breakout. All right, then you get the other one, which is the throwback. So people say, well, to wait for it to break and then come back up and then take it short. All right, again, advantages, disadvantages. The disadvantage is, well, you're not going to get the trade if the triangle just breaks to the downside and just keeps going down, 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 down. Then you don't have a trade. Okay, not the end of the world. Fine, make the market come to you. In other words, you say, well, I'm only going to trade throwbacks, so it didn't happen this time. Doesn't matter, I don't care. That's the attitude you just have to have if you're going to do that. But even here, it could be a little challenging, because if that's your first throwback and then it comes back and it breaks this high, and now you got to deal with that psychologically. Oh man, now you're in the red up here, and you see your P&L go red. It didn't go in your direction right away. Indecision, and it's just tough to deal with. So I don't deal with either one of those. I trade inside the triangle, as it says here. And this goes back to the principle of professionals always get in before amateurs. We're always getting in early. These are the two techniques that everybody in their parakeet knows. So I'm not going to use a technique that everybody in his parakeet knows. Because by the time you got a technique that everybody in their parakeet knows, it stops working or it gets messy, just like that. So no, I go short here. This is how I trade triangles. And it's funny because I actually get some flack on this. People say, well, you're not really trading a triangle breakout. And no, I am. And as much as I explain that, I still get feedback from people that know I'm not. What they don't understand, and I sometimes have a hard time helping them grasp this, is that the purpose of the trade is for a triangle breakout. And I understand where they're coming from, because they're right. I'm not trading at the time of the breakout. Again, it has to do with timing. But I'm trading the breakout. That's the purpose of the trade. It's still a triangle trade breakout pattern, structure. That's its purpose. That's its goal. But I'm trading before the breakout because I want to get in before everybody else. So I trade it up here. So I trade it right there. And by the way, wave three, failed 5. Yes, it made a higher high, but not a significantly higher high. That is, and again, I don't have time to go through all the rules of the wave counts here. We can get that from me another time if you want to. But what this means is it rejected breaking out of this high. Again, another failed 5 with regard to that wave 3. So we've had 2 of those. Now remember, the average wave count is 5. That means some trends have to have less than 5 waves, like this one. To have an average, you got to have some that are more and some that are less than 5. So this one only went 3, attempted to break out twice, failed both times. This, by the way, is called the top dog trading rule of 3. If the market tries to break out one way or the other of support resistance or some sort of pattern, and it fails after 3 times, it's probably not going to go in the near future. Now, next month, next quarter, it might, sure, give it enough time. But for right now, in this moment that I'm trading, That means that the market sentiment, I mean, there's very strong logic behind this. It just means that people have been looking at this. There's been attempts to go to make that breakout above the high wave 3. There hasn't been enough demand. It's simply supply and demand. When it gets up there, the marketplace, which is all the people and the algos and the computers and all that stuff, they're just saying, nah, not willing to pay that high of a price. I don't think it's going to go higher. And so people come in and short it. And so that happens 3 times. Just think, 3 strikes, you're out. So now my sentiment goes to the downside. We're in a triangle. I'm looking for expansion of volatility. I'm looking for a big move. And so I just take my trade right in there, sit through this. Now, my P&L is not going green and red, green and red, green and red. It's staying green through all of this. And I'm just looking, yep, okay, fine. And then boom, then our volatility cranks to the downside. Good risk reward, good win-loss ratio on it, professional style of trading, getting in before everybody else sees it. I have other things such as the wave counts that help me make this a high probability trade. By the way, there's another thing that makes this a high probability trade. In fact, I'll ask you guys, we're here live. Let's do a little interaction. Anybody else see anything here that would make this a high probability trade? And I'm giving you a little clue by just referring to these 3 highs here. Type it in. Type it in if there's anything else that, okay, lower high says James, that's good. Yes, Colin, very good. So James and Colin are both right. So lower high, good, but even more of a broad picture. Yeah. Okay, more people are getting it now. I think we just maybe have a little bit of a lag here. So good, Colin and Bill and Eric and Jay, head and shoulders pattern. Exactly, look at that. You just predicted what I did put on my next slide. So look for when you get triangles, here's another little pro tip. When you get a symmetrical triangle, look also to see if there's a head and shoulders inside of that. I call these concurrent setups. Concurrent setups. In other words, you've got 2 different setups occurring at the same time, and the trigger around them to enter would be at the exact same time. Head and shoulders and triangle. Concurrent setups have an even higher probability trade because there's 2 setups to take on that time. Very good. You guys are smart cookies. All right, so let's go to our third pattern, finish up with our third one. This one is I call detachment from equilibrium. So again, remember the principle is we're looking for contracting markets, and we wait and wait and wait until we get a good probability trigger. All right, and again, the tricky thing about these is there are often a lot of fakes. So this is why I don't trade the breakout, because the breakouts used to work really good, and they still work sometimes. I'm not saying they never work. And if you have a good, system and method, and you've got some other tools that help you determine that breakout will succeed. And I do have one of those. And if I get a breakout and I get, for example, block trades that come on a breakout, I'll trade the breakout in that particular case, because that tells me there's blocked trades. That means big money trades. And then, yeah, that has a high probability of actually breaking out and following through without anything else going on. But if it's just retail trading, then usually the breakouts fail and they become fake outs. So breakouts good, fake outs bad. So detachment from equilibrium, here are the 2 primary tools we're using here. Pivot point, or central pivot, it's sometimes called, and yesterday's close. So these are 2 different calculations of equilibrium in the market. So think of it this way, yesterday's close, what does that mean? Well, that means literally after all was said and done, after yesterday's trading, market going up and down and flipping around and doing, somersaults, whatever, that close of the price means that's what the market participants valued the market at after all was said and done that day, after all the news, the rumors, the gossip, the emotion, the tweets, whatever. And it's settled, and it used to be called settlement. It's still called settlement in the futures market. And settlement sometimes can be different than the close, but these days it's almost always the same. So yesterday's close, okay. So then when you look at today's market, you compare it with yesterday's close. If it's above yesterday's close, then people say, okay, we're bullish today. If it's below yesterday's close, it's red. If you're looking at like a ticker tape or something like that, it'll be red. And we're below yesterday's close, okay, bearish. Now, the other way to measure it, so we're going to put two together, is with your floor trader pivots. And your pivot point, your central pivot, is that equilibrium, that balancing point, the central point of value for the market. Now, it's based on yesterday's high, low, and close. And that draws today. So pivot point would be your equilibrium. S1 is support 1. S2 is support 2. And here's another little pro tip for you as an aside. Didn't even plan on sharing this, but it's there, so why not point it out? S1/S2. That's called a mid pivot. And it's very simple. It's just simply 50% of the distance between S1 and S2. That's all. But most people don't use them. Most people don't use them. And they are very powerful. They really, really work really well, especially if the previous day had was a wide range day. And this is a way of finding support resistance levels between S1, S2, R1, R2, etc. Okay, so what we do here is we take that as a zone. So between pivot point and yesterday's close, you can draw those in, but here I'm highlighting it in yellow to acknowledge that we're not going to use each just as a line now. We're going to use them as a zone of equilibrium. So we watch for the market. The market actually opened up. It gapped up, as you can see here. That was the close. Gapped up, but came careening back down, right back into equilibrium. Came down, broke yesterday's low. Now, that's another area of demarcation where, at least I was taught back in the days of yore, been doing this for 50 years, by the way, because my dad was a stock trader, so he started teaching me when I was 8. We used to literally hand draw charts back in those days on graph paper. Can you imagine that with a pencil? Yeah, because we didn't have computers. So that's how I learned to trade, was drawing bars. It was pretty ridiculous. But at that time, it seemed normal because, well, no such thing as a computer, at least not that we had access to. So anyway, one of the things that I was taught, if you break yesterday's low, that's a good trade. If it breaks yesterday's high, that's a good trade. That's when you really enter a bullish or bearish market. These days, doesn't work so well. Again, because everybody in his parakeet knows it, right? It's the old everybody in his parakeet rule. That's an ancient Chinese trading technique that I just made up. But seriously, so everybody's looking at this, the retailers are, and then it comes right back in. Fail to break out. Okay, breaks down again. Now everybody's like, oh yeah, definitely. Nope, not so much. So I wait for it to go back into equilibrium again. Okay, that's where I want to take my trade. I want to trade it before everybody. I want to let everybody else play their little games, all the little noise. If it does go down from here, again, don't have trader's remorse. Oh well, who cares? Take that money, put it somewhere else. What do we got here? We got Disney. So if Disney's not cooperating that day, it doesn't. Your pattern doesn't set up on Disney, whether it's this or any other one. Okay, go to Apple. If Apple's not setting up with one of your setups, then go to crude. If crude isn't, then go to gold. If gold isn't, do the euro. If euro isn't, do the yen, do the e-mini, do whatever. Trade the market that is giving you the setups that you've already established have a high probability statistically and mathematically. And don't chase the market. Make the market come to you. That's what that means. So, comes back in. Good. Finally, let's do this. And what does it do? High volatility comes back in. This is your low volatility zone. And now finally, boom. By the way, I talked about mid pivots before. bounces off here, goes to S1, goes to S2, goes to S1, goes to S2, hovers around S1, S2 for a while, and then goes all the way down. Where does it end? It ends down at the mid pivot of S2, S3. Great target, which, by the way, also has this blue dash line here that is simply a previous swing low from the previous day, or it could go back several days. We draw these out into the future. So I look, again, just like on the last one, or all of them here, I look for clusters of support resistance. And I like those clusters to be uncorrelated support resistance. So what that means is if you're using, let's see, well, if you're using the same kind of support resistance, like Fibonacci maybe, and they both come in at the same level, that's good. But it's even better if they're two different calculations of support resistance. So this one is the floor trader pivot, and that's the solid line. And then the dashed line is not based on that mathematical formula at all. It's based on a previous low that the market actually put in. So that gives me great confidence to just take profits there. Made the money, take the muffins when they're passed. Many muffins were passed. You're getting the whole plate on this one. And that is a great risk-reward ratio. Okay, that's how you catch big moves. Again, the basic principle behind catching big moves is getting in during low volatility markets and then riding it as we go into a new high volatility cycle. Timing the low volatility to high volatility cycle and getting in just before that high volatility cycle kicks in. Once it kicks in, it's kind of late. Not saying you can't make some money, but you've given up a lot of reward already. You've also given up probability because, well, now everybody's seeing it. Most people are very, very nervous to trade low volatility markets. They want to wait too long. They want to wait till everything's confirmed. And it sounds like a good idea. It sounds reasonable. I want to wait till everything's confirmed because it sounds like then you have more certainty. And that is one of the biggest psychological challenges in trading is people want to wait for certainty. In other areas of life, that can serve you very, very well. And so we get used to that because we know, yeah, in many areas of life, wait for certainty. In trading, it's counterintuitive in that way. By the time you've got certainty, it's kind of like when they say, when a stock, when you see that company on the front of Time Magazine or Newsweek or whatever, it's too late. And it's not too late in the sense that you can't make money, but the big money has already been made. Right now, everybody knows about it. So the real sweet opportunity is before it shows up on the cover of magazines, before everybody knows about it. So we gave you 3 patterns today to trade. One of the questions that comes up a lot is, all right, well, these are, we're trading these during low volatility. So how do we know which direction it will break? And again, I guess I've only got 5 minutes. So the general answer, again, there's only so much I could do in 45 minutes here, but the general answer is I look at momentum on the next higher time frame. So I've got a momentum indicator I use it on the next higher time frame. If momentum is up on the next higher time frame, I'm only going to look for the market on the shorter time frame to break to the upside, for that volatility cycle to break to the upside. And conversely, if momentum is bearish on the higher time frame, then I'm only going to look for the breakout of the low volatility cycle to the downside. So I've already made that demarcation. I know which way it's going to break out ahead of time. So I'm not chasing it. And this is where a lot of people get chopped out as well. They don't understand that, the breakout happens to the downside, but if you looked over at the momentum on the higher time frame, it's up. So that's why the momentum keeps you on the right side of the trade, because if it's up on the higher time frame and you trade a breakout on the lower time frame, it's not going to follow through. And that's when you get the fake instead of the break. And also, super important, as we talked about, how early or late to enter. So that is an excellent question again. So we got 4 minutes. Tell you what I'm going to do. I have a recorded webinar. I don't do this webinar live anymore, but I have a market timing indicator that I share for free. It's not an indicator you have to import or download. There's no charge for it because it's really just a common indicator that's already on every charting platform I've ever seen, but I do modify it. I make some modifications to it. So I've recorded that webinar now, and it's absolutely free for anybody who wants to access that. I show you how to set up that timing indicator on your charts, and then I show you how to trade it. It takes about 45 minutes, and be happy to give you that recording for free. So here's what I got for you today. First of all, I feel like I was rushed. If you have any questions about any of this or anything else, feel free to send me an email at barry@topdogtrading.com. So there's my email address. And I'm going to give you a free mini course today. It includes one of my favorite trade strategies. I actually take this trade every single day it sets up. It's so good, I scan for this every single day. So I still take this trade. It's called the rubber band trade. And it also is kind of based on volatility. It's a reversion to the mean, so it's actually the opposite. After we got a high volatility cycle, then we look for a low volatility cycle, and we can trade that side of it as well. And that's what this trade is. It's actually easier to trade. That's why I give this away for free, because I want to prove to you that I can make you money before I ask for any money. So take this before you buy my course, or never buy my course, totally up to you, whatever. I just figure this is the best way to, prove myself to you, is to get you making some money right away. So you got all the details of the rubber band trade. There's 5 videos included, interactive quizzes, there's feedback loops, rubber band trade, and then also the free webinar on my cycle indicator, which is again my timing indicator, which I use on every single trade to time myself into the market. And it's very objective. I know exactly where I'm getting into the penny, to the pip, to the tick. I nail swing highs, nail swing lows using this indicator. So feel free, you get all of it by just going to one place, topdogtrading.com/free. And you can get everything there. I thought instead of breaking it all up into different pages, just go to topdogtrading.com/free and get everything right there. And I'll type in the URL